Hello everyone. So first of all, I hope I'm clearly audible. Good evening, good evening. Just let me see if it is visible for the YouTube also. Okay, just give me a second. Okay, it is visible for the YouTube students also. Nice. Okay, so welcome to the session, everyone. First of all, do tell me if the voice is clear, the screen is pretty clear, everything is audible and visible. Yes, nice. Good evening, everyone. Good evening. All well. Okay, nice. Chalo. So this is your first session for your general awareness part for the phase one. So for the RBI Grade B 2026 examination, for the phase one, there will be different sessions. There will be sessions for the RBI NewsTap. Okay, there will be sessions for the reports tab that you are getting, the schemes tab that you are getting. For the current tab, for the GA section, there will be separate sessions for the GA plus ESI, and for the GA plus finance, there will be separate sessions. So I hope, first of all, you have seen the schedule. Okay, so today we are starting with the general awareness RBI News tab part. Okay, so this is your first live practice session for the general awareness section of your phase one. And today we are going to cover the RBI News tab for the March 2026. Okay. So this is the agenda for today. I hope you have seen the document. If you have not, then do not worry. Today, I will show you the document, as well as through the PPT also, we will have the discussion about the different articles, and all your articles that are provided in the document for the RBI News tab for March 2026 will be covered in the session. So now, first let's discuss about the importance of the RBI notifications and the RBI press releases. Okay, so in the RBI News tab document, you are getting the RBI notifications and the RBI press releases, as well as you also get the master direction, you also get the circulars that are in the notification recently. Okay, so let's discuss the importance of the RBI notifications, RBI press releases. So see, in 2024, there were around 18 questions from the RBI notifications, RBI press releases, as well as the RBI report. As at that time, the annual report was released before the examination. So from the annual report, from the different reports of the RBI also, there were multiple questions. Okay. In 2025, there were 7 questions from the RBI notifications, from the RBI press release. Because basically what happened that your examination, the phase 1 was in October, and the annual report released in May. So the annual report lost its importance because it released way earlier than the phase 1 examination. Okay, that's why there were no questions from the annual report in your phase 1, and the number of questions decreased from 18 questions to only 7 questions from the RBI website. But this time what will happen that by 29th May or by 31st May, your annual report will be released of the Reserve Bank of India. And so before your examination, just before the examination, the annual report will be released, and this will become a very important document from which a lot of questions can be expected, or number of questions can be accepted. Okay, so in 2024, there were 18 questions from the RBI notifications, RBI press releases, RBI reports, and in 2025, there were 7 questions from the RBI notifications, RBI press releases. In this year, 2025, there were no questions from the RBI reports. That's why you can see a dip in the number of questions. Okay, but still 7 number of questions are very much. And this time the number of questions can increase because of the annual report that is going to be released before the examination. So this is the basic idea. Now, the RBI News tab, RBI notifications, press releases, they are not only important from the phase 1 perspective, but they are also important from the phase 2 perspective. Here you can see that in 2024, there was only one objective question from the RBI website. But in 2025, even though in phase 1, there were less number of questions, but in phase 2, there were directly 2 descriptive questions from the RBI website, from the RBI notifications, RBI press releases. So in phase 1, if there are less number of questions, but the number of questions increased in the phase 2, spatially descriptive like holds more weightage. Okay. Now, these were the kind of questions that came in phase 1, 2025. So you can see that directly like one-liner questions or these kind of questions have come in the phase 1. So if you have gone through the articles, if you have gone through the facts, if you remember the facts, you will be directly able to answer the questions. Okay, so these kind of questions have come from the RBI notifications, RBI press releases particularly. Now in phase 2, the questions were from the RBI, like from the RBI News Tab or from the RBI notifications, RBI press releases. These kind of questions have come. In the FM, there was a question about the AI that was from the free AI report, from the free AI report. Another question here you can see, this is the question that came from the Monetary Policy Committee statement, okay, from your RBI website. So in the phase 2, there were 2 descriptive questions from the RBI website. So I hope you know the importance of the RBI website, you know the importance of the RBI notifications, RBI press releases. So all of this is getting covered in RBI NewsTap. And today we are going to cover the RBI NewsTap of March 2026. I hope this is clear. So what will be covered in the sessions? Now coming to this point, that what we are going to cover in the session. So will your magazines be covered in the session? Absolutely correct. That if you are taking the reports tab session, so reports tab document will be covered for the month that has been laid down in the schedule. If you are taking the RBI NewsTap session, that means you will be getting the material from the RBI NewsTap magazine. If you are taking the Schemes tab session, if you are joining the Schemes tab session, that means that document will be covered. Okay. As we have less time, so we will try to cover the magazines in a faster manner, and then with the MCQs, we will be practicing the questions as well as we will be revising the important points. So this is the idea that yes, your magazines will be covered. Okay, your magazines, your documents that are provided in the course, they will be covered through the sessions, and the sessions are being conducted so that there is the coverage that can be provided to you. And as we have less time, so with the magazines, through the MCQs also we will try to cover the important points. Okay, now in the RBI NewsTap particularly, as you know that RBI NewsTap is one of the most technical part in the general awareness section. So when it comes to the RBI NewsTap, RBI notifications, RBI press releases, everything like cannot be discussed through the magazine. Okay, so in the magazine, all the material has been provided, but if directly I open the magazine and I try to explain you, you might not be able to understand all the points. Okay, that's why I have made the PPTs for the other, for the GA plus ESI, for the GA section, for the reports, for the schemes. You might not get the PPTs directly from the magazines. The things will be taught to you. But for the RBI NewsTap, because it is very technical in nature and many of the students are not able to understand the points, so that's why I have prepared the PPTs. I have brought the PPTs. So first we will do the content through the PPTs, and then we will also go to the magazine to see that okay, everything has been covered, your different points have been covered, so that you are able to understand, as well as your coverage is also done through the magazine. The MCQs, after every article we will do the MCQs, so that you are able to see that what kind of question can come from this particular article, as well as you can also practice. Okay, so your coverage, we will focus on your coverage so that your magazines are being covered. You do not have to do the efforts again. So your coverage will be focused on through the PPTs, your understanding will be focused on, and through the MCQs, your practice will be focused on. So this is how these things will be covered in the session. Yes. So PPTs, the PDF of the PPT will be shared with you. So in the session itself, I will share the PDF of the PPT, as well as after the session in the course also, you will get the PDF of the PPTs, annotated as well as without annotation. Both the PDFs you will be getting. Any question now? Okay. Munish, right now, as you have limited time, so just focus on the sessions and the magazines that are provided to you. Even for static GA, there are 2 sessions that have been allocated. So we are trying to cover everything that can come in the examination, but you do not have to attempt 80 out of 80 questions. You have to target like 40 to 45 questions. Okay, so do not worry about it. Through the magazines, you can cover the important areas. Okay. Yes, PPTs will be provided in the course. Do not worry about that. You do not you do not have time to go beyond. Right now, just focus on what is being provided. No. See, FSR right now, just focus on the recent 3 to 5 months. Whatever content has come in the recent 3 to 5 months, those months you have to focus on more. First, focus on the 3 months. And then if you get the time, if you think that, no, I don't want to take the risk, then you can cover the 5 months. But remember that most of the questions, they do come from the recent 3 months for the phase one. Okay. Yes, you can rely on the classes, but of course, you will have to revise through the magazines. You will have to revise the content. If you are going through the sessions, the things will be covered for you. But revision is a must. Even after covering everything, you will not be able to answer in the examination if you are not revising enough. Okay, so revision is something that you will have to do yourself. Every 9C, the things will be provided in the sessions itself. Okay, the static, yes. There is static GA session that will also be taken in, it is given in the schedule. Chalo, now let's start. Let's not waste the time. Let's start with the articles. Okay. First, let me show you the document so that we will be covering. Okay. Are you able to see the document, everyone? Okay. So today we are going to cover the RBI NewsTap for the March 2026. Okay, so this is the document that we are going to cover, and this document contains the uh, notifications, press releases, circulars that are released by the Reserve Bank of India. Okay. So now this is the RBI NewsTap document, and it is divided into two parts. First is 1st to 15th March 2026, and the next part is 16th to 31st March 2026. Okay. So in the first part, see, there is the color coding that has been done. Color coding basically means the blue actually means that it is more relevant or more important from the phase one perspective. Okay. So this blue means that it is more important from the phase one perspective. Red means that it is more important from the phase one as well as from the phase two perspective. If there is no color coding, that means first cover the blue and red articles. Then after that, you can cover these articles that are not color coded. Okay. Then this is the second part. Here is the second part, that is RBI NewsTap 16th to 31st March. Okay, here also you can see that color coding has been done. These articles are important from the phase one perspective. These articles are more important from the phase one perspective. And these articles, the red articles, they are important from the phase one plus phase two perspective. So the color coding has been done so that you can prioritize that first you have to do the blue and the red articles for the phase one as well as for the phase two, then the non colored articles that you have to do. Okay. So now we are going to start with the document, and we are going to start with the first article for today, that is the renewal of the bilateral swap arrangement between Japan and India. And first we are going to cover the articles in the same manner. We are going to cover the articles first. The first article we will cover, then we will cover the color coded articles first. So then the fourth, fifth, sixth article, and then the rest of the articles we will cover, and the non color coded we will cover at the last, at the end of the session. Okay. But do not see, some questions can come from this also, like the question can come on this also, but they are on less priority. So we will do it at the end of the session. So we will go in this manner, that first we are doing the color coded articles, and then at last we are doing the non color coded articles. I hope this is very much clear. Shall we start now? We are going to start with the PPT. So now, after getting the clarity that what we are going to do, let's get started with the session. Okay. So first, renewal. Give me a thumbs up sign so that I can, like, I know that all of you are prepared now for listening to me. We will discuss all of that, Ritvik. Do not worry about it. Give me a thumbs up sign, fire sign, or yes, so that we can start with the articles. In the YouTube also, I hope all of you are ready. So let's get started. Okay. Chalo. And see, I will be asking you some questions. So I want all of you to answer. Okay. Yes, Anuj. I hope you have seen the schedule. Jan and Feb month will also be covered. So let's start now. Renewal of the bilateral swap arrangement between Japan and India. See, between Bank of Japan acting as the agent for the Minister of Finance, Japan, and the RBI, they have signed the third amendment and the restatement of the agreement of the bilateral swap arrangement. What is the bilateral swap arrangement, first of all? See, in the bilateral swap arrangement, what happens that let's say India is in the need of dollars. India needs the dollars. So India will have to go to the IMF or World Bank to take the dollars. But see, there is a bilateral swap arrangement that has happened between India and Japan. Through this bilateral swap arrangement, whenever India needs the dollars or whenever Japan needs the dollar, so under the swap arrangement, they can avail the dollars, they can take the dollars from the other country. So let's say India needs the dollars. So instead of directly going towards the IMF and the World Bank, India can ask Japan to give the dollars to India. Okay, so this is the bilateral swap arrangement that we are going to understand. So let's say that India is initiating. Japan can also initiate, but in this case, we are taking the example of India. So let's say India initiates and India asks for the dollars. So India is giving the rupees. India will give the rupees to Japan as a collateral and will take the dollars from Japan. Okay, so India is giving the rupees, the domestic currency, and we are taking the dollars that we need. So after like the contract finishes, let's say the contract is for 1 month, 2 month, 3 months. So when the contract finishes, India will give back the dollars with some interest and India will take back the rupees. Okay, so this is the bilateral swap arrangement, that there is a swap that is happening. First, we are giving our rupees to take the dollars, and after the contract finishes, we will return the dollars. We will return the dollars with the interest and we will take back our rupees. So this is the bilateral swap arrangement that can help India in the that is in need of dollars, or in the case Japan is in need of dollars, so India will help Japan. So this is the bilateral swap arrangement. It is a two-way arrangement. That means India will help Japan, Japan will help India whenever there is the requirement, where both authorities can swap their local currencies in exchange for the US dollar. The size of the bilateral swap arrangement remains unchanged since 2019. The bilateral swap arrangement amount has been decided, that is $75 billion. This is a huge amount. That is the bilateral that comes under the bilateral swap arrangement. Okay. Chalo. So exchange rate, the contract is signed, and in the contract itself, the exchange rate is also laid down. And in the contract, the timeline is laid down that when the money will be returned, at what exchange rate, at what value the money will be returned. Okay. So bilateral swap arrangement, in the document, it has been clearly laid down that it is an agreement between the central banks of two countries that allows them to temporarily exchange their domestic currencies with the dollars. Under this mechanism, if one country is facing a shortage of the dollars, it can use its domestic currency to get the dollars from the other country. This arrangement works on a temporary swap basis, and this is the bilateral swap arrangement. Now, let's see some background. So, India-Japan bilateral swap arrangement between Reserve Bank of India and Bank of Japan was established in 2008 with a size of $3 billion. In 2011, it was decided that the amount of the bilateral swap arrangement will be increased from $3 billion to $15 billion. Okay, for the time period of 2012 to 2015. So initially, the bilateral swap arrangement, you can understand, that was decided in 2008 between the Bank of Japan and Reserve Bank of India. So initially, the bilateral swap arrangement was for the value of $3 billion. Then what happened that in 2011, it was decided that the amount of the bilateral swap arrangement will be increased to $15 billion for the time period of 2012 to 2015. But in 2013, again, there was discussions that happened, and it was decided that with effect from 2014, the amount of the bilateral swap arrangement will be increased to $50 billion, so that more help can be provided to the other country whenever required. Okay. And in 2019, February 2019, it was decided that the amount of the bilateral swap arrangement will be $75 billion. And this amount is still valid. And the Bank of Japan and the Reserve Bank of India, they have done the third amendment and restatement agreement that we are continuing with the bilateral swap arrangement with the same value of $75 billion that was decided in 2019. Okay. Now this bilateral swap arrangement Japan and India believe that the bilateral swap arrangement, this aims to strengthen and complement other financial safety nets. So yes, India can take the help of IMF, World Bank, or the other countries, but this bilateral swap arrangement, it provides a safety net for India and Japan. This will further deepen financial cooperation between the two countries and contribute to the regional and global financial stability. So here, through this infographic, you can remember the important idea that the bilateral swap arrangement is between India and Japan, and it is of the value of 75 billion. Now, give me the answers. This is the first question in front of you. Try to answer the question. Yes, very good, everyone. The answer here is Bank of Japan. So Reserve Bank of India has entered into the third amendment and restatement agreement of bilateral swap arrangement with which of the following central banks? With the Bank of Japan. Okay. Next question. With reference to the renewal of the India-Japan bilateral swap arrangement between India and Japan in March 2026, what is the maximum swap size retained under the arrangement? It is correct, $75 billion. Okay, so here the amount is important as well as the central banks, they are important. Now, coming to the next article, that is going to be a lengthy article. So RBI Commercial Bank Prudential Norms on Declaration of Dividend and Remittance of Profits Directions 2026. Okay, so let's see that. So first of all, declaration of dividend. So profit, let's say the company is earning the profit. Like the profit is divided into three parts. Can anyone tell me that what are the three parts in which the profit is divided? Okay. So profit is divided into three parts. What are the three parts? The profit. See, from the profit, first the tax has to be paid. That is corporate profit tax. The corporate profit tax has to be paid. After paying the corporate profit tax, then whatever is left goes for the undistributed profits, that is the retained earnings and the dividend. Okay, let's say that the profit earned is 100 rupees, so corporate profit tax is, let's say, 30, so 70 rupees is left. From that, 30 is the undistributed profit that the company is keeping with itself. The rest, how much will go as the dividend to the shareholders? So shareholders will receive 40 rupees. The rest of the amount will be given to as the dividend to the shareholders. Shareholders will receive the dividend. Okay. So this is how the profit is usually distributed. Okay. And the profit. So here, RBI Commercial Banks Prudential Norms on Declaration of Dividend and Remittance of Profits Directions 2026. So these directions have been released. These directions have been released by the Reserve Bank of India for the commercial banks. Okay. So first of all, RBI issues the rules for the banks about how they can declare their dividends to the shareholders, and foreign banks having branches in India, how they can send the profits to their head office. Why the RBI is intervening in this regards? Because see, if the banks, they are giving, let's say, from their profit, they are paying the tax, and after that, they are giving the whole amount as the dividend to the shareholders. They are not keeping enough of the retained earnings. They are not keeping enough of the undistributed profit. So what will happen? The banks will not have enough funds for its future operations, for its future expenses, and to handle the distress, the banks will not have enough funds. So RBI is saying that you have to be very careful when you are providing dividend to the shareholders. The banks have to keep in mind that they have enough money, retained earnings with themselves, so that they can handle the distress, they can continue their future operations. Got it? So this is the idea. So RBI issues rules for banks about how they can declare the dividends, what amount of dividend, like what percentage of dividends they can declare and such. And the foreign banks having branches in India, how much profits they can send back to their head office, to their parent company. So for this, the rules have been laid down. The rules, 2025 rules, they have been repealed now, they have been taken off, and the new rules have been released by the Reserve Bank of India. Okay. Now these directions shall be applicable to all the banking companies corresponding new banks and State Bank of India and foreign banks operating as branches in India, excluding the small finance bank, local area banks, payment bank, regional rural banks. For all these other category of banks, separate notification has been released by the Reserve Bank of India. So this notification is for the commercial banks, that is all banking companies, corresponding new banks, State Bank of India, foreign banks operating as branches in India, excluding these categories. For these categories, there is separate notification that we will discuss after this. Okay. Now, you will understand this better. Now, coming to the profit after tax, adjusted profit after tax. So profit after tax is what? First of all, profit after tax is basically the revenue of the bank, the total revenue of the bank minus the total cost, minus the operating expenses, the minus the interest that has to be paid. Okay, so from the total revenue, when the total cost has been deducted, the operating expenses, the interest amount that has to be paid, that has been deducted. So this shows the profits. This shows the profit before tax, Okay, so this is the profit, total profit we can say before tax. But after deducting the tax also, we have the profit after tax. Okay, so from the total revenue that is earned by the bank, deduct the cost of the bank, the operating expenses, the interest that has to be paid, deduct the tax also. So we have the profit after tax. This is the profit that is left with the bank after paying the tax. This is also known as the net profit. This is also known as the net profit. Okay. So see, from the total revenue, the bank has to deduct the total cost. This is the gross profits. From the gross profits, the bank can deduct the operating expenses. The bank has to deduct the interest that has to be paid. The bank has to deduct the tax also. So then the bank will come to the net profits. The net profit is nothing else. It is known as the profit after tax. Any confusion here? Any confusion? Yes, total cost, it contains the salaries and such. Okay. The cost of the, see, you do not have to remember this. It is just to give you an idea that what is the profit after tax. Profit after tax is basically the profit that the bank is earning after paying the taxes. That is the profit after tax. You do not have to go to formulas. That will not be asked in the examination. Just the concept has to be clear, right? So any confusion in the concept? The profit after tax? The profit after tax? So profit after tax is the profit that is left with the bank after paying the taxes. Okay. So from the total revenue, deduct the total cost. That gives the gross profit, total profit. From the total profit, from the gross profit, deduct the operating expenses like the marketing cost, administrative cost, general cost has to be deducted. Operating expenses of the bank has to be deducted. And then from this, deduct from the gross profits, also deduct the interest that has to be paid and the tax. So then it is the net profit. Net profit is nothing else. It is the profit after tax. So now from the profit after tax, you have to come to the adjusted profit after tax. This is something that is important. Okay. What is adjusted profit after tax? Adjusted profit after tax is the profit after tax minus 50% of the net NPAs. Non-performing asset. Now, non-performing assets are those assets, the loans that the banks have given. So remember, first of all, that loans are the assets of the bank. Loans are the assets of the bank because, see, the bank has given the loan. The bank has given the loan on which the bank will earn the interest. So loan is the asset of the bank because the bank is earning returns on the loan. So bank is giving the loan and bank is earning interest on that. So loan is the asset for the bank. Now, non-performing asset basically means those loans that are not being repaid. So if the borrower has defaulted, borrower is not paying the loan. So the NPA is the non-performing asset. Such loans that are not being repaid by the borrower. The borrower has defaulted. So these are the non-performing asset. Now from the gross non-performing asset, that is the total, from the total non-performing asset, deduct the provisions that the bank is maintaining Okay, let's say the total non-performing asset is 100 crore for the bank. The bank is already maintaining the provisions of 90 crore. The bank already has enough of the buffers. The bank has the provision, extra provisions of 90 crore. So what is the net NPA? What is the net NPA? 10 crore. 10 crore is the net NPA. Now 50%. So net NPA, I hope you have understood that the gross NPA minus the provisions that the bank has. So that is the net NPA. Net NPA is 10 crore. 50% of 10 crore is 50% of 10 crore is 5 crore. So from the profit after tax, deduct the 50% of net NPA, that is adjusted profit after tax. Okay. So adjusted profit after tax is the profit after tax minus 50% of the net NPA. Provisions are the extra amount, the buffers, the capital that the bank is maintaining to handle its non-performing asset, because the bank already knows that some of the loans will become the NPAs. So bank already has some provisions. Okay. That is the formula that the RBI has given. You will have to mail the RBI to ask that why this is there. Okay. So now adjusted profit after tax is the profit after tax of the financial year in which the dividend will be declared, for which the dividend will be declared. Profit after tax minus 50% of the net NPA. This is your adjusted profit after tax. Now try to answer this question. No, Beneath, we will discuss that. Net NPA is your gross NPA minus the provisions that the bank has to handle the gross NPAs, to handle the NPAs. Chalo, RBI has introduced the concept of adjusted profit after tax to ensure that banks with weak asset quality do not distribute excessive dividends. Okay. In this context, which of the following correctly explains the computation and purpose of the adjusted profit after tax? So basically, what is the formula of profit after tax that has been given by the RBI? That is reducing the reported PAT, reducing the reported profit after tax by 50% of the net NPA, of the net NPA. So this is your adjusted profit after tax. Okay. So this is the idea. Now adjusted profit after tax will be lesser than the profit after tax, because profit after tax, let's say, is 50 crores. From this, we are deducting 50% of net NPA, that is 5 crores. So adjusted profit after tax is, let's say, 45 crores. This is the idea. So adjusted profit after tax is reduced, like is lesser than the profit after tax. If a bank has higher net NPAs, then the adjusted profit after tax will be high or low. Anyone can tell me? If a bank has too many NPAs, very high NPAs, if the bank has very high NPAs, non-performing asset, so the adjusted profit after tax will reduce. If the net non-performing asset is, let's say, very high, so the adjusted profit after tax will reduce, right? Basic maths, that is. So this is the idea that adjusted profit after tax, I hope it is clear. Now, while declaring the dividend or remittance of profit, so dividend can be declared by the bank, commercial bank. Remittance of profit is declared by the foreign banks that have branches in India. Okay. So the declaring of dividend or remittance of profit, the foreign banks that have branches in India, they are sending their money back to their own country. So remittance of profit means they are sending the profit to their own country. So declaring of dividend or remittance of profit, for this, the board of directors shall consider the current and projected capital position, that do the bank has enough of the capital with itself. Okay. So not only the current capital, the bank should maintain good current capital, but the bank should also have the capital for the future. Okay. So basically, what is the idea that, see, against the risk weighted asset is what? The loan that the bank is giving, basically. So that is the asset for the bank. Now, each and every loan has some risk weight. If the loan is given to micro, small and medium enterprises, let's say the risk weight is considered 70%, 80%. If the loan is given to a big corporate, let's say the risk weight is 50% or something. So each and every loan has some risk attached. Some loans have higher risk, some loans have lower risk on the basis of your credit score and such. So risk weighted assets, against the risk weighted assets, the capital has to be maintained by the bank, so that the bank has enough of the capital to handle the stress. Okay. The bank has enough of the money to handle the stress. So this is the idea that against the risk-weighted assets, against the loans that the bank is giving that has certain risk weight, the bank is maintaining enough of the capital. So this is the capital to risk-weighted asset. This is the capital to risk-weighted asset. That is the capital divided by the risk-weighted asset. Now for the commercial banks, any idea that what is the CRAR? What is the CRAR? CRAR is for the commercial banks. The CRAR is 9%. The CRAR is 9%. So basically, the banks have to maintain the CRAR of 9%. The commercial banks, they have to maintain the CRAR of 9%. So against the risk-weighted assets, the bank should have enough capital with themselves. That is, if the risk-weighted asset is 100 crore, the bank has to keep the 9 crore of the capital. This is the current capital that the banks have to maintain. The bank should be maintaining 9% of CRAR. Projected capital position, that means for the future also, the bank should have enough of the funds available that the bank is able to maintain the CRAR in the future also. Applicable capital buffers. Now the commercial banks, they also have to maintain the capital conservation buffer, that is additional buffers of 2.5%. 2.5%. Okay. So basically, against the risk weighted assets, against the loans that the bank is giving that has certain risk weights, the bank has to maintain the capital. The bank has to maintain the capital. So when the bank is giving the loan, on the basis of the risk weight of that loan, on the basis of the risk attached with the loan, the bank has to maintain the capital. That is known as capital to risk weighted asset ratio. Now this is 9% for the commercial banks, and the capital conservation buffer, that is the additional buffers that the bank has to maintain, is 2.5%. This is the idea. So while declaring the dividend, the board of directors shall consider the current as well as the future capital position, that are we able to maintain the 9% of the CRAR, as well as do we have enough of the buffers that is mandated. This is the minimum that the banks have to maintain. This is the minimum capital that the banks have to maintain. And the adequacy of provisions. The provisions are separate amount that the banks are keeping to handle their NPAs. Okay. So do we have enough of the provisions also? Do we have adequate provisions? Taking into account the economic environment, the stress in the economy, as well as the bank's long-term growth plans, on the basis of all of this, the dividend has to be declared. See, while declaring the dividend, the board of directors have to keep in mind that from their profit, how much dividend can they declare and how much of the retained earnings or the undistributed profit should they keep with themselves. If the profit after tax is, let's say, 100 crores, so can we provide the dividend of 70 crores and keep the undistributed profit as 30 crores? The bank will see that, okay, we do not have enough capital, we do not have enough provisions, so we need to keep the distributed profit as 70 or 80 crores, and only 20 crores of dividend will be shared with the shareholders. Got it? Is this clear? So the bank has to see that what is the current position, the capital position that the bank has. Do the bank has enough of the provisions? If the bank has enough of the provisions, if the bank has enough of the capital buffers, if the bank has enough of the capital position, then the bank can declare higher dividend also. But if the bank does not have sufficient buffers with itself, then it should not declare higher dividend. That is the basic idea. Okay. That is the basic idea. So basically, while declaring the dividend, the board of directors, basically, they have to keep in mind that how much capital buffers do they have, how much of the capital, how much of the provisions do they have. If they have sufficient provisions, they can declare higher dividend. But if they do not have sufficient provisions, they will have to declare lower dividend for the shareholders. That is the idea. So auditors report, on the basis of all of these, the bank decides its dividend. Now, a bank shall meet the following prudential requirements to be eligible to declare the dividend. So these criteria have to be followed. The bank complied with regulatory capital requirement. The bank complied with the regulatory capital requirement. So basically, the bank has complied with the minimum regulatory capital requirement. Means this is the minimum capital that the bank has to maintain. Everyone, what is the minimum capital that the bank has to maintain? What is the minimum capital risk weighted asset ratio? What is the minimum capital requirement for the commercial bank? Very fast. What is the percentage? 9%. Very good. Should it be maintained only for this year? Should it be maintained only for this year? Or for the previous year also? Or for the future also. So bank complied with the regulatory capital requirement at the end of the previous financial year. In the previous financial year also, they have maintained the capital buffer as well. They have maintained the minimum capital requirement as well as for this financial year also, they are able to maintain the capital. Okay, so bank complied. The bank has complied with the minimum regulatory capital requirement at the end of the previous financial year and continue being compliant in the current financial year also when they are proposing to release the dividend. After paying the dividend in the future, after paying the dividend, the bank must still be able to meet the minimum capital requirement of 9%. So in the future also, they should be able to maintain the capital buffers. The bank incorporated in India, that is the commercial bank that is incorporated in India, shall have the positive adjusted profit after tax for the period for which the dividend is proposed. So you will be able to release the dividend only when you have a positive adjusted profit after tax. Okay, so a bank will only be able to release the dividend when they have the positive adjusted profit after tax. A foreign bank that is operating in the branch mode in India, that means the foreign bank has a branch in India, they shall have a positive profit after tax. So for the bank that is incorporated in India, such as the State Bank of India, Punjab National Bank, SDFC Bank, ICICI Bank, that are the Indian banks basically, they need to have a positive adjusted profit after tax to release the dividend. But a foreign bank that is operating in the branch mode, they only need to have the positive profit after tax to release the dividend. Okay, sorry, to release the profits to their head office. Okay, the bank is not subject to any restriction from the bank will only be able to release the dividend. The bank will only be able to release the dividend when the bank branch of a foreign bank will only be able to release the profit to its head office in the other country when the banks are not under the restriction from the Reserve Bank of India or any other authority. Okay, so this is the idea. Chalo. Is this all clear? And see, capital buffers, CCB is your capital conservation buffer. These are the additional capital that the bank has to maintain. So minimum capital requirement is 9% of the risk-weighted assets. But the capital conservation buffer, this is the additional capital of 2.5% against the risk-weighted asset that the bank has to maintain. Now, coming to the next point, see, a bank incorporated in India which satisfies. Now this is how the dividend can be released, or these are the percentages how the dividend can be released. Okay, just give me a second. Okay, let's continue. I hope everything is clear. See, a bank, the CRAR is how much? First of all, what is the CRAR? We will discuss the other banks in the coming notification. Do not worry about it. CRAR is how much? Okay, CRAR for the scheduled commercial bank is 9%, right? Out of this, how many of you know that the capital to risk weighted asset ratio? So against the risk weighted asset, the bank has to maintain the capital. Hai na? Against the risk weighted asset, the bank has to maintain the capital. That is your CRAR. How many of you know that it is divided into two parts? That is your tier 1 capital and tier 2 capital. I hope everyone knows tier 1 capital is considered the liquid capital that the bank has. That means liquid funds, liquid asset that the bank has, that the bank can use in the distress situation to handle the problems, to handle the distress. Tier 2 capital is like the physical asset that the banks have, or the asset that the bank has that is not liquid. So this tier 2 capital cannot be used immediately during the distress. Now this tier 1 capital is divided into two parts. That is common equity tier 1 capital. This is the most liquid capital that the bank has. Okay, and then the additional tier 1 capital. So this is basically your static part, but I have to explain it so that you have the clarity. CRAR is divided into tier 1 capital, tier 2 capital. Tier 1 capital is further divided into common equity tier 1 capital and your additional tier 1 capital. Tier 1 capital is liquid, that can be used during the time of distress. Common equity tier 1 capital is the most liquid, and the the undistributed profits are basically added in the common equity tier 1 capital. Okay, so the higher the undistributed profits, the higher the retained earnings, the higher will be the common equity tier 1 capital. That's why the RBI is saying that maintain good undistributed profit. The banks need to have the good undistributed profits. The bank need to keep some undistributed profit with itself so that it has enough of the liquid capital to handle the distress. Now, so this is the basic idea. Think about it. CRAR is 9%. It is said that out of this 9%, 5, 6, 7% should be in the form of tier 1 capital. That is minimum 7% should be the tier 1 capital, and the rest 2% can be the tier 2 capital. So out of the tier 1 7%, CET, common equity tier 1 capital should be 5.5% minimum. The rest 1.5% can be AT1 capital. Okay, so this CRAR of 9% maximum should be in the form of tier 1 capital, because that is the liquid capital that the bank can use during the distress immediately. Tier 2 capital can be up to 2%. Now, common equity tier 1 capital, this is the most liquid capital that the bank has to handle the problematic situation. So common equity tier 1 capital 5.5%. Now, if the bank, how many of you now know about the capital conservation buffer? Capital conservation buffer is how much? 2.5%. This is the additional capital that the bank has to maintain, right? Now, in which form do you think that the bank has to maintain the additional capital? In the form of common equity tier 1 capital, AT1 or tier 2? In which form do you think RBI mandates the commercial banks to maintain the additional capital? That is the capital conservation buffer. Just take a guess. Now I hope you will know. Yes, because this is the capital that can handle the distress on the immediate basis. So RBI says that the common equity tier 1 capital in this form maintain the additional capital that is of 2.5%. So in total, the bank will be maintaining the common equity tier 1 capital of how much? 8%. 8%. Okay? 8%. So what is the minimum requirement of common equity tier 1 capital? 8%. Let's say the bank is only maintaining 8%, up to 8%, less than 8% or equal to 8%. Should the bank be allowed to provide the dividend? If the bank is only able to, the bank is providing less than 8%, the bank has the common equity tier 1 capital, the bank has the capital less than 8%. Or let's say just equal to 8%. So should the bank be allowed to pay the dividend? No, the bank should not be allowed to pay the dividend because the bank does not have enough capital to handle the distress. So how can we allow dividend when the bank does not have the liquid capital with itself, the liquid money with itself? So 0%. This is the logic behind the dividend payout. Okay. Now let's say the bank has above 8%, but less than 10%. So in this case, 20% of the dividend will be allowed from the adjusted profit after tax. So if the adjusted profit after tax is 90 crores, from that 20% of the dividend payout will be allowed. Okay, this is the basic idea. Any confusion here? Even if it is equal to 8%, that is just the minimum, the bank should hold more. No confusion? So this is the idea. This is how the brackets are maintained. So in total, there are 10 buckets. These buckets depend on how much the bank has the common equity tier 1 capital. This is the most liquid capital that the bank needs to maintain the liquidity and to handle the distress. Okay, up to 8%, 0% of dividend. If the common equity tier 1 is up to 8%, now there will be a gap of 2% till bucket 5. So here, and the increase of the dividend payout by 10%. Okay, rest 1%. If the bank has the common equity tier 1 capital, the bank is maintaining very good common equity tier 1 capital of above 20%. In this case, 100% of the adjusted profit after tax will be allowed to pay as the dividend. You don't need to memorize it. If you can understand the basic idea that up to 8%, this is the minimum common equity tier 1, so 0%. Do not memorize it, understand the logic, okay? If the common equity tier 1 capital is more than 8%, This is what is required now, more than 8%. So in this case, the dividend payout can be 20%. After that, 10% will be the increase in the dividend payout. If there is the increase in the common equity tier 1, in the starting bucket 5, 2% increase in the bucket common equity tier 1 value, and the rest 1%. Z, we will come to Z. Coming to that point. Now, see, there is another point that is mentioned. See, let's say that the profit after tax is 100 crores and your 50, the net NPA is 10 crore. So what will be the adjusted profit after tax? What will be the adjusted profit after tax? 50% of the net NPA should be 5 crore, na? So 100 crore minus 5 crore, adjusted profit after tax will be 95 crores. Now it is said that the bank can give 100% of the adjusted profit after tax as a dividend. Yes or no? If the bank has above 20% of the common equity tier 1 capital, so it is said that the 100% of adjusted profit after tax can be given as dividend. That means how much can be given as dividend? How much can be given as dividend? 95 crores, because 100% of adjusted profit after tax, that means 95 crore can be given as dividend. Now the RBI said that this can be problematic because we are giving maximum as dividend. So RBI said that, okay, there is additional clause that we are imposing, that the bank can give maximum up to 75% of the profit after tax. That means profit after tax is 100 crores, 75% of profit after tax is how much? 75 crore. So even though it is said that the bank, as per the bucket list, it is said that the bank can give 100% of adjusted profit after tax as the dividend, but there is another clause to limit the dividend, that is 75% of profit after tax. Let's take another example so that you have clarity. Let's say that the profit after tax is 100 crores and the net NPA is 50 crores. 50%, or let's say it is 80 crores. 60 will be better. 60 crores. What will be the adjusted profit after tax? Tell me fast. What will be the adjusted profit after tax? 50% of 60 crores, that is 30 crore now. So adjusted profit after tax will be adjusted profit. Very good, everyone. 70 crores. 70 crores. 100%. If 100%, let's say a bank is maintaining very high common equity tier 1 capital of more than 20%. So dividend payout can be 100% of adjusted profit after tax, that is 70 crore. Okay. Now, what is the, can this be paid out? Can this be paid out as the dividend, or is there the clause that is limiting? It can be paid out because this 70 crore of the dividend payout, it is still less than the 75% of the profit after tax, that is 100 crore. So what will happen, that this 70 crore can be paid out. This is the just the limiting clause so that too much of the payout is not happening. Got it? Chalo. किसी को कोई confusion? Because I will be closing this slide now. Any confusion, anyone? देखो, basically lower of these has to be paid out as the dividend, either the adjusted profit after tax or the 75% of that. Okay. Chalo, no confusion. Very good. Very good. So dividend allowed as a percentage of adjusted profit after tax can be 100%, but there is the limit. There is the limit of 75% of PAT. There is the limit of 75% of profit after tax. This is the idea. Now, common equity tier 1 capital. See, for the NPAs now, the bank is maintaining separate provisions. If the bank has enough provisions, the bank already maintains separate provisions. The common equity tier 1 capital is only used when there are extreme distress situation that the bank is facing. Okay. Otherwise, this is just the bank is maintaining this to handle the extreme distress situation. Otherwise, the bank has already enough of the provisions. Okay, now coming to this. See, coming to this Z part. Now let's discuss this Z part. Okay, what is this Z? How many of you know about the domestic systemically important banks? Domestic systemically important banks are the banks that are too big to fail. Which any example that you can give me of any bank that is too big to fail? Any bank that is too big to fail in our country? I know that SBI, SDFC is very good, everyone. So see, domestic systemically important banks, they are the banks that are too big to fail. That means if they fail, it can lead to a problematic situation in the country. So this is the list of the domestic systemically important banks. These are the systemically important banks. Okay, State Bank of India, SDFC Bank, ICICI Bank. Because State Bank of India is the highest one, so it has to maintain the additional common equity tier 1 capital. All the other banks have to maintain the common equity tier 1 of 5.5% plus the capital conservation buffer in the form of common equity tier 1 of 2.5%. So this is how much? 8%. In addition to this, the domestic systemically important banks, they have to maintain the additional common equity tier 1 of 0.80% for the State Bank of India, 0.40% for the SDFC Bank, 0.20% for the ICICI Bank. Got it? So this Z in the table 1 refers to the respective applicable buffer that the domestic systemically important banks have to maintain. This is only, Z is only for these three banks that are the domestic systemically important banks. Okay? Chalo. Any confusion, anyone? And now try to answer this question. Correct, Tejas. Very good, everyone. Very good. Why not A? Why not A? I'm so good to see all of you are answering correctly. So good to see that. Why not A? Because higher. Like I gave you the example also, 70 crore was the dividend payout as per the percentage of the adjusted profit after tax. Okay. While 75% of the PAT is the maximum that can be paid out. So out of these two, the lower is the dividend payout that happens. So the lower of, very good. Everyone gave the right answer. That is B. Lower of dividend permitted under the common equity tier 1 bucket or 75% of the reported PAT. The maximum that can be given is this, not more than this. Okay, so lower of these has to be paid out. Either the lower of dividend that is allowed as percentage of the adjusted PAT or the 75% of the PAT. Okay, now to summarize everything, the eligibility to declare dividend or to remit profits, compliance with the regulatory norms is required. Capital has to be maintained for the previous financial year. In the previous financial year, you must have followed the minimum capital requirement. And at the end of the current financial year also, you should be maintaining the capital requirement. Capital requirements, even after the dividend payment, you should be able to maintain the capital requirement. In the previous, in the present, in the future, you should be able to maintain the capital requirement. Profit condition, profit positive. Like the Indian banks, they can give the dividend when they have a positive adjusted profit after tax, while the foreign bank branches in India, they can remit the profit when they have positive profit after tax. Okay, so this has been laid down here. Now, the adjusted PAT is the reported PAT, that is reported profit after tax, that is profit after tax minus 50% of net NPAs. Okay, so that is adjusted PAT. Now, on the basis of what the dividend payout will happen, on the basis of the common equity tier 1 ratio. Okay, and the common equity tier 1 ratio, on that basis, the buckets are divided into 10 buckets. Starting 5 buckets have the increase of 2%. According to that, the dividend payout is increasing. So on the basis of the buckets, there are dividend payout that has been laid out on the basis of the adjusted profit after tax. Overall ceiling, the maximum that can be given is 75% of the profit after tax, and the maximum permissible dividend is the lower of the dividend according to the bucket or the 75% of reported PAT. Any confusion, anyone? Chalo. Now we are coming towards the end of this particular article. Quantum of remittance. So we have discussed about the dividend payout. Now coming to the remittance of the net profit or surplus. Remittance by the foreign bank branches, the profit See, the foreign bank branches in India, the foreign bank branches that are in India, they can remit the profit to their own country. Okay, so the bank branches of the foreign banks in India, they can remit, they can send the profit to their own country if they follow certain criteria. First of all, they need to have the positive profit after tax. So a foreign bank operating in India in the branch mode that satisfies the eligibility criteria, that is, they have the positive profit after tax, they can send the net profit or surplus, that is the profit after tax basically. Net profit is always profit after tax that is earned. They can send it to their own country without prior approval of the Reserve Bank of India if they have the positive profit after tax, if they are following the capital requirements, if they are maintaining the enough of the capital with themselves, if they have the requirements met, they can send the money to their own country. They can send the profit to their own country without prior approval of the Reserve Bank. That means if the foreign bank branches in India, if they have enough capital, if they had enough capital in the previous financial year, if they have enough capital in this financial year, if they can have enough capital in the coming financial year, as well as they have the positive profit after tax, they can remit the profits to their own country without prior approval of the Reserve Bank. Subject to the conditions that the accounts of the bank are audited. That means the profit that they are showing should be true. And in the event if excess profits have been sent, mistakenly more money has been sent outside, so the head office of the foreign bank immediately shall return the excess remittance. Okay. Now, profits not eligible for dividend or remittance, which profits cannot be paid out as dividend or which profits cannot be given as remittance to the other country. So, extraordinary profits, that is the one-time profit, suddenly there is a boom that has come, or there is a lot of accounts that have a lot of money that has been earned by the bank. So if there is an extraordinary profit, that is a one time or unusual event, in this case from this particular profit, dividend cannot be paid out, remittance cannot be paid out. If the audit report by the statutory auditor, that is the legal auditor, has given the audit report that there is overstatement of profit, actually the bank has mistakenly overstated the profit. So from this overstated profit, dividend cannot be paid out because this is overstated profit. This is not the actual profit. Bank shall not pay dividend or repatriate profits out of net unrealized gains arising on fair valuation of level 3 financial instruments. Level 3 financial instruments are basically those financial instruments that are illiquid, that does not have the they have the unobservable valuation. That means their valuation cannot be observed clearly in the market. They are not very liquid, their value cannot be observed easily. So bank shall not pay dividend, bank shall not send the profit outside if there are unrealized gains, that is from these level 3 financial instruments, that are the illiquid unobservable valuation kind of instruments. कौन से limits? Which limits? Yes, level 3 financial instruments, like I told you, level 3 financial instruments are such financial instruments that are not very liquid. That means they are illiquid and their valuation cannot be observed in the market. That's why they are considered level 3. That is not good financial instruments. And for these kind of financial instruments, the unrealized gains can be noted in the books of the bank, but it cannot be used to share the dividend. I hope this is clear. That's why I'm waiting, because I know this can be a little problematic. So basically, profits not eligible for dividend or remittance. Extraordinary profits, they from this dividend cannot be paid out, remittance of profit cannot happen. If the audit report is stating that there is overstatement of the profits by the bank, so from the overstated profits, dividend cannot be paid out because these are not actual profits. These are just overstated. Bank shall not pay dividend or remittance of profit from the unrealized gains that are not realized. They can be seen in the market, but they are not realized actually. So from the level 3 financial instruments, because they usually have unobservable valuation in the market, they are not trading much, and that's why their valuation is always not very clear. I hope this is clear. Okay. Remittance of profit is allowed. Remittance of profit is allowed when the bank has complied with the minimum capital requirement for the previous year, for the current year, for the future also, as well as when the foreign bank is able to have the positive profit after tax, then the remittance of profit is allowed. Okay, these are the conditions. Now read it again. I know that too much of the facts, too many of the concepts, very hard financial concepts are mentioned here that you might not have studied. So you need to go through it again. Okay. Level 3 financial instruments, it can be the derivative contracts that are the customized derivative contracts that are usually not traded much in the market. Yes. In one go, for sure, you will have the issue. Okay. Now, coming to that, a bank paying dividend or remitting profits to the head office shall report to the Department of Supervision of the Reserve Bank of India within a fortnight of declaration of dividend or remitting profits to head office. So basically, they have to report to the Department of Supervision of the Reserve Bank of India within a fortnight of declaring such profits or such remittance of profit or dividend within 15 days. Correct. So remittance of profits by foreign bank in India, they are able to remit the net profit to their own country after the tax has been paid. No prior RBI approval is required. They just have to follow some conditions. That means they need to have the positive profit after tax and the capital requirements they should be able to meet. Profits not eligible for dividend or remittance, extraordinary profits, excess profits that are because of the accounting errors or adjustments, that is overstated profit. From this, the dividend cannot be paid out. Unrealized valuation gains from the level 3 financial instruments that are usually not traded in the financial market. Profits arising from the reversal of excess provisions. So if there are excess provisions that were maintained by the bank, if they have been reversed, that means the bank is keeping it with itself. From these excess provisions, the profit cannot be paid because these provisions are just for your safety, for the bank safety. From this particular excess provisions, dividend cannot be paid. Okay. Now, any confusion? Done. This is done. Now, as I told you that these all guidelines, they are applicable for the commercial banks. Now, for the small finance banks, local area banks, payment bank, and regional rural banks, the other guidelines have been mentioned. What are those other guidelines? Actually, these same adjusted profit after tax, these same basic guidelines will be followed, but the table is different for the small finance bank, for the payment bank, for the local area banks, for the regional rural banks. So basically, these banks, the RRBs, small finance bank, payment bank, as well as the local area banks, they also have to follow the basic guidelines. That is, they need to maintain the capital requirement, the minimum capital requirement for the previous year. For the current financial year, they need to maintain the capital. Even after the dividend has been paid out, they need to have the positive adjusted profit after tax. Okay, so these basic guidelines are same for these criteria of banks also, but the table is different for them. Any confusion? Should we discuss this table? If there is no confusion, because you need to put your mind here now if you want to understand this. Yes, Juhi. Actually, na RBI notifications from the RBI. See, there are 4 or 5 different notifications were released. 5 different notifications were released. I will show you that also. So those 5 different notifications have been compiled under this particular article. So you are seeing this one article, but this is the accumulation of 5 different notifications that I will show you. No, for adjusted profit after tax is for all the banks. Okay. Coming to that, shall we start discussion on this table? Chalo. Okay. See, now what happens that CRAR for the commercial bank is how much? 9%. For the small finance banks and payment bank, anyone knows that what is the CRAR? 15%. Very good. And in the case of commercial banks, there is the mention of the capital conservation buffer of 2.5%. But in the case of other banks, actually, there is no mention of this capital conservation buffer separately. So when we talk about the commercial banks that are usually the big banks, State Bank of India, Punjab National Bank, SDFC Bank, ICICI Bank. So usually in the case of these commercial banks, there is the CRAR of 9% plus the capital conservation buffer of 2.5%. While for the small finance banks and the payment banks, the CRAR is directly 15% and there is no mention of the capital conservation buffer. Okay? Got it? Chalo. So for the small finance bank and payment bank, the CRAR is 15%, but they have to maintain. See, on the basis of their tier 1 capital, how much tier 1 capital are they able to maintain? On the basis of that, the dividend can be paid out. Okay, for different categories of bank, now there are different criteria. For the commercial banks, it was common equity tier 1 capital, but for the small finance bank and payment bank, it is tier 1 capital. So small finance banks and the payment bank, the small finance bank and the payment bank, their CRAR requirement is 15%, but they need to maintain the tier 1. The minimum tier 1 capital that they have to maintain is very good, 7.5%. 7.5%. So remember that the CRAR requirement for the small finance bank and payment bank is 15%. But the tier 1, let me write it here so that you will get it in the annotated PDF. Small finance bank and the payment banks, they need to maintain the CRAR of 15%. Under the CRAR, their tier 1 capital requirement is minimum 7.5%. Let's say that the small finance bank and the payment bank, they only have 7.5% of tier 1 capital. Or let's say they have less than 7.5% of tier 1 capital. That means they are not able to maintain the minimum, or they are only having the minimum. Should they be allowed to pay the dividend? No. But let's say if they have more than 7.5% and up to 9.5%. So same formula will go that till bucket 5, there will be the increase of 2% in the criterias, and there will be the increase of 10%. So you just need to remember the criteria. If you know the criteria, you don't have to remember the table. There is no need for the table. You just need to keep in mind that tier 1 capital for the small finance bank and payment bank, the minimum tier 1 capital is 7.5%. And from here, the table will start that for 7.5%, no dividend will be paid out. The rest, 2% increase karte raho. And with that, the 10% will increase in the dividend payout. Got it? Is this clear for the small finance bank and payment bank? Any confusion? Small finance bank and payment bank, no confusion? Very good. Chalo, coming to the local area banks. For the local area banks and for the regional rural banks, the CRAR is 9%. Okay, as well as the CRAR for local area bank is 9%. So if the local area bank is only maintaining the minimum of 9% or less than 9%, should they be allowed to pay? No. So 0%. And again, 2% keep on increasing 2%. The dividend payout will increase by 10%. In the till bucket 5, 2% increase. After that, 1% increase. Okay. See, what is important from this whole table is this, that on what basis the dividend payout will happen. Dividend payout will happen on the basis of the tier 1 capital for the small finance bank and payment bank, for the CRAR for the local area banks. Okay. And dividend will be allowed from the adjusted profit after tax. What is adjusted profit after tax? It is profit after tax minus 50% of net NPS. This is what you have to keep in mind mostly. The rest is not very important. Okay. Rest, you can understand the logic. Now, for the scheduled commercial banks, 9% is CRAR. From the 9% of CRAR, tier 1 capital was how much that the banks had to maintain? Minimum tier 1 capital, 7%. Tier 2 capital was 2%. Now for the regional rural banks also, for the RRBs also, for the regional rural banks also, 9% is the CRAR and the tier 1 capital is 7%. If they are maintaining the 7% of tier 1 capital, that means they are maintaining only minimum or less than minimum. Should they be allowed to pay the tax? Should they be allowed to pay the dividend? No. And rest? Same goes. 2% increase, 10% dividend payout increase. Okay. Till bucket 5. After that, 1%. It is on the basis of the RBI has decided it because the focus areas, maybe because of the focus areas. Okay. Scheduled commercial bank are the big banks. They are usually in more distress or stressful situation, or they are the ones that are the big banks that are more important from the economic perspective when it comes to the deposits that they are gathering. So for them, common equity tier 1 is the most liquid that they have to maintain. For the other banks, on the basis of their working conditions, this has been decided. Table is relevant for the phase 1. This is relevant for the phase 1. I will be asking you rapid fire questions. Okay. Now, before ending this topic, regardless of the bucket list, see, for the commercial bank, what was the maximum that can be paid from the profit after tax? What is the maximum for the commercial banks? The maximum of 75% could be paid from the profit after tax. For the small finance banks and for the payment banks, 75% of the profit after tax is maximum that can be paid as the dividend. For the RRBs and for the local area banks, for the RRBs and for the local area banks, the maximum is 80% of the profit after tax that can be paid out. Okay, shall I ask you the rapid fire questions now? For the commercial banks, what is the criteria for deciding the dividend payout from the adjusted profit after tax? For the commercial banks, it is common equity, tier 1 capital. For the small finance banks and for the payment banks, what is the criteria? What is the criteria? Fast. What is the criteria for the small finance bank and payment bank? It is tier 1 capital. For the RRBs, what is the criteria? Tier 1 capital. For the local area banks, what is the criteria? CRAR. Very good. Now, how much the commercial banks can pay maximum of the profit after tax? 75%. For the RRBs, what is the maximum can be paid from the profit after tax? 80%. For the small finance bank and payment bank, what is the maximum that can be paid? 75%. Okay. These are the most important points that you have to remember. The table I have explained you. Now, what is the minimum tier 1 capital for the small finance bank and the payment bank? Minimum tier 1 capital. 7.5%. What is the minimum CRAR for the local area banks? 9%. What is the minimum tier 1 capital for the RRBs? 7%. What is the common equity minimum common equity tier 1 capital for the scheduled commercial bank? It is 5.5%. Adding the capital conservation buffer, it becomes 8%. Okay. So these are also important percentages that you have to keep in mind. Now, a bank paying, see, for the region, as I've told you that there were different notifications now. So see, for the RRBs, different notification was released. For the small finance banks, different notification was released. For the local area banks, different notification was released, that we have compiled in one so that you have the, like, in the limited time, you can compare and you can remember. So for the RRBs, prudential norms on declaration of dividend that we have discussed. For the RRBs, we have discussed. Okay. And their maximum that can be paid that we have discussed. Now, for the RRBs, there is a special point that, see, for the other banks, all the other banks, small finance bank, local area banks, payment banks, commercial banks, they have to report to the Department of Supervision of the Reserve Bank of India. But in the case of RRBs, the supervising authority is who? Anyone. In the case of RRBs, very good. In the case of RRBs, the supervisory authority is NABARD. Also. Okay. So in case of RRBs, so for the other banks, RBI is the reporting authority. But in the case of RRBs, reporting will be done to the Department of Supervision of the NABARD within a fortnight of declaration. And the same points that were applicable for the commercial banks, these same points are applicable for small finance bank, local area bank, regional rural bank, payment bank. But the last point about the level 3 financial instruments is not applicable for RRBs because RRBs usually are not allowed to invest in these instruments. Any confusion now? Gecko, like the data that I've told you, that is important. Okay. And actually now here the minimum percentages have been given, and that's why it becomes important to remember. So it's not like that you are studying static. Basically, the minimum percentages are important because they have been mentioned as the bucket one. No, whatever points I'm telling you, just focus on that. Yes, Ritika, all the finance topics, they are a part of all the static concepts, they are a part of finance. Okay. So till then, answer the question, and the students that have confusion, they can ask. These are the kind of questions that I've given here. Which of the following statements is correct regarding the maximum permissible dividend ceiling of the banks as per the RBI? So basically, small finance banks and payment banks cannot declare dividends beyond 75% of profit after tax, and RRBs and LABs, local area banks, they are permitted up to 80% of profit after tax. So C is correct. So these are the kind of questions that can come in the examination. Okay. The questions I've shown you now. So a question can come on the adjusted profit after tax. A question can come on the basically the buckets, as well as the 75% of the maximum that is allowed. Basically, the question can come on the RRBs, LABs, and such percentages. The question can come. So these are the normal questions that can come. Okay. Now, coming to the last part, that is RBI. Okay. Now we are going to start with the new notification. New notification. Any confusion, anyone? Foreign versus Indian banks के लिए limit, which limit? Okay. See, I'm writing it down here so that later on you can see. For the scheduled commercial banks, basically the CRAR is 9%. Tier 1 capital is 7%. Tier 2 this is minimum. This is minimum. Okay. This is minimum requirement. Tier 2 capital can be 2%. And in the tier 1 capital, there is common equity tier 1 capital, that is the most liquid capital, that is 5.5%. And the additional tier 1 capital is 1.5%. And common equity tier 1 capital, so CCB, capital conservation buffer is 2.5%. And this usually has to be kept in the form of common equity tier 1 capital. Chalo, this is it. ठीक है आप? Yes, this criteria will continue for the foreign banks. Tier 1 is 7%. Common equity tier 1 is 5.5%. If we add the capital conservation buffer, that is the separate buffers, then we have the CET1 that is equal to 8%. Okay. Yes, only part for foreign. Correct. Chalo. Now, shall we continue with the next one? Reserve Bank of India commercial banks prudential norms on capital adequacy. Now, if I'm giving a loan, do I have any risk? Yes. The risk depends upon. Now I do the micro, small, and medium enterprise has the same risk that like a corporate entity, big corporate entity? No, they have different risk. Now, if you have a credit score of 780, someone has a credit score of 200, do they have same kind of risk? No, right? So on the basis of your risk, like there are risk weighted assets, like the loans, they have different risk. So there are the risk weighted assets. Different loans, they have different risk. Against the risk weighted assets, what the bank has to maintain? If the bank knows that risk is there, so bank has to maintain the capital against the risk weighted assets. That is known as capital risk weighted asset ratio. So this is known as capital. This is also known as capital adequacy ratio. That means the bank has to maintain the adequate capital. For the scheduled commercial banks, the minimum capital adequacy ratio is 9%. This is the idea. Now, this is the basic idea that we have gathered. This idea will help you in this direction also, okay? So basically, RBI has decided to amend the RBI commercial banks prudential norms on capital adequacy. There are certain norms, there are certain rules and regulation regarding the capital adequacy, regarding the adequate capital that the banks have to maintain. Directions 2025 to provide greater clarity. Now there is the amendment that has happened in the commercial bank prudential norms on capital adequacy. There is the amendment that has happened to provide greater clarity. There is to provide greater clarity and to largely align them with the international standards. So basically, there is the amendment that has happened in the capital adequacy rules, in the capital adequacy norms. There is the change that has happened. Now, why the change has happened? To provide clarity regarding the capital adequacy, as well as to largely align these norms with the international standards. Okay. This amendment direction shall come into effect from the immediate basis. Applicability of the direction is on the commercial banks, small finance bank, payment bank, and all India financial institution. So these directions are applicable on the commercial bank, small finance bank, payment bank, and all India financial institution. Basically, again, the RBI released 4 different notifications that we have compiled in this one article. Okay, so 4 different notifications were released by the RBI for the commercial bank separate, for the small finance bank separate, for the payment bank separate, and all India financial institution separate. But now in this one notification that we will be discussing, we have compiled the different points so that you do not get confused studying the same again and again. So basically, this article we are going to study for all the different categories, and the applicability of the direction is on the commercial banks, small finance bank, payment bank, and all India financial institution. Now, the bank is giving the loan. That is the asset for the bank. Do the bank also invest? Yes. How many of you know about the derivatives? Yes. So basically, if you are not aware about the derivatives, I'm not going to explain it in detail. Just the basic idea I'm going to give you. Derivatives are the financial contracts that derive their value from some underlying asset. Okay, so derivatives, they derive their value from the value of shares, or the derivatives, they derive their value from the foreign currency, or from the interest rate in the rupees, or the interest rate of the foreign currency, or let's say some commodities. So derivatives are the financial contracts. Derivatives, they are the financial contracts that derive their value from some underlying asset, Let's take the example of the foreign currency. Let's say I want to purchase after 1 month, that is on 30th of May, I want to purchase $1,000. I'm afraid that by 30th May, I don't know, maybe $1 right now, it's 83 rupees. It might become 90 rupees or 100 rupees, sorry. So too much hike will happen in the value of dollars. I want to purchase $1,000 after 1 month. So right now I will come into a financial contract stating the facts that I want to purchase $1,000 at the rate of $1 equal to 83 rupees. And I will be getting these dollars on 30th of May. So I will purchase this kind of financial contract, and there will be a seller of the financial contract that want to sell this $1,000. Okay. So this is basically the idea. Derivative contracts, this contract, its value is dependent upon the foreign currency. Got it? Now, so banks, they are the banks are providing the loans. For the loans, there is risk. Can we say for the derivatives, they do not have any risk? Derivatives, oh, they do not have any risk. No, derivatives also have some risk. So the bank is investing in the derivatives, but derivatives also have some certain risk. That is known as the counterparty credit risk. Let me give you an example, and through that example, we will understand the counterparty credit risk. Let's say the Bank of India is having a financial contract with the Bank of America. Okay? Bank of India wants to buy $1 million on 30th of May. That is after 1 month, and Bank of India wants to purchase it. Like Bank of India and Bank of America are coming to agreement that the Bank of America will sell $1 million at $1 equal to 83 rupees, and Bank of India will purchase it at that. Okay, so this is a What kind of game? Oh, sorry, this is a what kind of contract? It is a forward contract. Like the derivatives, they derive their value from some underlying asset. Here, the underlying asset in the financial contract, the underlying asset is foreign currency. The derivative value, it depends upon the foreign currency. $1 equal to 83 rupees. Okay. Now, the derivative contracts can be future contracts, forward contracts, swaps, options. So right now we are focusing on forward. This is a forward derivative contract, okay? That in the future, on this particular date, the settlement will happen. Let's say that right now, what is the date today? 30th of April, right? Let's say after 10 days, by 10th of May, $1 is equal to 90 rupees. Which party is the gaining party here now? Which party is the gaining party? Bank of India. The Bank of India is on the gaining side. It is on the gaining side because the Bank of India knows that the dollar prices are increasing, but the Bank of India only has to pay how much? Even though $1 is equal to 90 rupees, Bank of India has to pay 83 rupees. That means we are saving on per dollar, we are saving 7 rupees. That means $1 million, we will be saving 7 million rupees or something. Okay. So you can understand that as per the contract, the Bank of India is on the gaining side. Who is on the losing side? Who is on the losing side? Bank of America. What if Bank of America says that, okay, sorry, we will not continue with the contract. We cannot continue with the contract. Bank of America can retract. The Bank of America can leave the position. So what will happen? The risk will come on the Bank of India. So this is the idea that here is the risk. That what if the other party leaves the position? What if the other party leaves the position? Think about the other situation. Think about the other situation. That what if by when, like 30th of May, by 30th of May, $1 is equal to 80 rupees. 80 rupees. Now what will happen? Who is in the gaining side? Who is in the gaining side? Bank of America. Because Bank of America will be selling $1 at 83 rupees, while currently $1 is equal to 80 rupees. So Bank of America is gaining right now, and the Bank of India is losing. It is losing because Bank of India has to pay $1, has to pay 83 rupees for $1 when it could have paid 80 rupees for $1. So Bank of India is losing 3 rupees per dollar. It is losing. So Bank of India can leave the position. Bank of India can leave the contract in this situation. So this is known as counterparty credit risk. That means there is a bilateral risk. There is a bilateral risk that what if the other party leaves the contract? It will be a problematic situation. So in the case of loans, let's say the Bank of India is giving the loan to the borrower. Who has the risk? Who has the risk? Borrower has the risk or Bank of India has the risk? Bank of India has the risk because it is the one that is giving the loan, right? But in the case of derivative contracts, who has the risk? Bank of India has the risk or Bank of America has the risk? Both the parties have the risk. That's why it is known as the bilateral risk. That if the Bank of America is on the gaining side, Bank of India might leave the contract. If Bank of India is on the gaining side, Bank of America might leave the contract, leaving the other party into risky situation. This is known as the counterparty credit risk. So in the traditional credit sense, in the traditional loan perspective, the risk is unilateral, one-sided. The bank is having the risk. But in the case of derivative contracts, in the case of financial instruments, there is a counterparty risk. Both the bilateral risk is there. Both the parties are in that risk. As well as the value of the derivative can fluctuate. That means right now, let's say $1 is equal to 83 rupees. This was the contract agreement. Right now, $1 is equal to 90 rupees. So what is the exposure that Bank of India has to the Bank of America? What is the exposure? 7 rupees per dollar. This is the exposure. This is the risk that the Bank of India has if the Bank of America says no for the contract, right? 7 rupees. What if $1 is equal to 100 rupees? Now, what is the risk for Bank of India? What is the exposure? Exposure means what is the risk for the Bank of India? The risk is 17 rupees. Let's say something happens, war happens, something happens, and now $1 is equal to 150 rupees. What is the risk now? What if Bank of India cancels the agreement now? What is the risk? It is as high as 67 rupees. So the risk is volatile, or the risk can change. So uncertain exposure is there. Uncertain exposure, the risk is uncertain. Risk can be your 2 rupees also, risk can be your 100 rupees also. Got it? Any confusion? So this is the counterparty credit risk, in which both the parties are in the risk, and the risk is very uncertain on the basis of the market condition. Risk is any time before settlement. Before the settlement, any time the other party can cancel. So both the parties have the risk. So counterparty credit risk is the risk that the counterparty means the other party, to a transaction could default before the final settlement of the transaction cash flows. CCR creates a bilateral counterparty credit risk, create a bilateral risk of loss. Both the parties have the risk of loss. Okay. Now, against this risk, if the bank is maintaining the capital against the risk of the loans, so should the bank not keep the capital against the risk for the derivatives also? Because the risk is there now. Bank is in the risk. What if in the future the bank faces this risk? So bank should be maintaining the capital against these risk also. That is the counterparty credit risk. Okay. So in the case of derivatives also, there is the risk. In the case of the financial instruments also, there is the risk. And against this risk also, bank has to maintain the capital so that this capital can handle the distress situation for the bank. Chalo. Now, we have said that there is uncertain exposure. There is uncertain risk. So how the bank can calculate this uncertain risk? Can you think about it? Is it not true? There is uncertain risk. We just said that there is uncertain exposure. There is uncertain risk. So if the risk is uncertain, we do not know the risk, how can we maintain the capital? How can we maintain the capital? So for this kind of thing, there are the formulas that are used. Estimation, very good, Aritra. Estimation is used, okay? Chalo. So because the risk is uncertain, we are not aware about the risk. In the traditional case, in the loan, we know the risk. We have given the loan of 10 crore, so this is the risk. Or let's say the risk weight is 30%. So 3 crore is the risk. So we can easily calculate the risk, okay, on the basis of the risk profile, on the basis of the credit score, on the basis of the profit of the company or the person that we are giving loan to, the income of the person. We can calculate the risk basically. In this counterparty credit risk, we are not able to calculate the risk because there are uncertain situation. In this case, there is the formula that is used, that is current exposure method. So we basically, for the derivative. Now, derivative are called off-balance sheet transactions. Just a second, huh? Let me. Anyone knows that why the derivative contracts are considered off-balance sheet? Just a second, okay? See, off-balance sheet transaction because they are the transactions that will be settled in the future. That's why they are not kept on the balance sheet. They are off balance sheet transaction because the derivative contracts, they will settle in the future. Okay. Now, the credit equivalent amount. So what we are going to do, we are going to convert this uncertain exposure to some value. That is credit equivalent value. Credit equivalent value. Okay. So credit equivalent amount of a market related off balance sheet transaction, that is basically derivatives. So current exposure method, credit exposure under. So what is the exposure? What is the exposure under the current exposure method? This is calculated as credit exposure, the exposure basically, exposure through the derivative contract. Current credit exposure, current exposure. What is the current exposure? Can you tell me what is the current exposure? I will give you the idea. The contract says $1 equal to 83 rupees. Right now, $1 is equal to 87 rupees. What is the current exposure? 4 rupees per dollar. This is the current exposure. If the other party defaults, we will have to pay 4 rupees extra. That means this is the risk that we are carrying. This is the risk that we are carrying. So current exposure just basically means the current value. Mark to market means the current value that we will be, we are in the gaining part, but the current value that we are gaining, if the other party defaults, this will become the risk and the loss. So this is the idea. So current exposure is basically 4 rupees per dollar. But now on the current basis, the contract is getting settled. Current, like it is on 10th May, but the contract will get settled on 30th May. So currently we know that the value is $1 equal to 87 rupees. What if it increases to 90 rupees? What if it increases to 100 rupees in the future by 30th of May? So we also calculate potential future exposure, that in the future, in the just coming period, what can be the risk. Potential future exposure is potential future credit exposure shall be determined by taking the notional value of the contract multiplied by add-on factor. Add-on factor is the formula. Sorry, it is the value that is given by RBI. So basically, if you want to see the credit exposure, if you want to see the exposure for the derivatives, we take the current exposure method, where we see the current credit exposure, current exposure plus the potential exposure that is in the future. Any confusion? Now the potential exposure, it depends upon the notional value of the contract, the value of the contract basically multiplied by the add-on factor that we are going to discuss in the coming slides. No confusion? So this is the idea that the credit equivalent amount, where we want to see the exposure that this derivative contract has. Here we take the current exposure in the current time period on the current day plus the potential exposure. Potential exposure has the formula notional value multiplied by the add-on factor. So add-on factors, we use add-on factors for the potential future exposure. We use add-on factors to calculate the potential future exposure. This is on the basis of the Basel Committee on banking supervision guidelines. So we stated in the start only now that we want to align. The RBI has amended the directions so that the directions can be aligned with the international standards, and the Basel Committee on banking supervision, it is the global standard setter for the regulation of the banks, So basically, Basel Committee on Banking Supervision Guidelines has stated that if you want to see the potential exposure, future exposure, basically, if you want to see, for that, you have to take the notional value multiplied by add-on factor. And these add-on factors that the RBI has provided, these are on the basis of the global standards. Got it? So basically, the add-on factors for the calculation of potential future exposure in the current exposure method, for the potential future exposure, we are taking the add-on factors. And this is according to the Basel Committee on Banking Supervision Guidelines, that is the global standard setter for the regulations of banks all over the world. Now, add-on factors are basically these values that have been given. That is it. So if let's say the derivative, the larger the time period, the higher the risk, can we say so? The longer the time period, the higher the risk, can we say so? Yes, because the longer the time period, the more fluctuations can come in the economic criterias, and the larger the time for the other party to default. So that's why the larger the time period, the higher the add-on factor is. Notional value is actually the value of the contract, the amount of the contract, okay? Amount value of the contract. So 1 year or less, these are the add-on factors. Over 1 year to 5 years, these are the add-on factors. Over 5 years, these are the add-on factors. What you have to remember is, first of all, for interest rate derivative contracts, for the exchange rate derivative contracts, and for the gold also, for the equities, for the shares, for which derivative contracts are being signed, and for the precious, like derivative contracts related to the precious metals except gold, like precious metals, if we are not including gold is here. So precious metals means silver, platinum, palladium. Other commodities means energy contracts, energy derivative contracts, agricultural contracts, base metals, any other non-precious metal commodity contracts. So the highest add-on factors is for the other commodities. Lowest is for the interest rate contracts. Okay, this is the idea. So basically, if you want to calculate the current exposure, you have to take the current credit exposure plus the potential future exposure. Potential future exposure is notional value multiplied by add-on factor. Add-on factor is provided by RBI according to the guidelines. Okay? Try to answer this question. I will suggest you that just see the pattern, that for the over 1 year and less, the least is interest rate contracts, then exchange rate contracts, then equities, precious metal, and other commodities. Okay, so the other commodities are the most risky, we can say. 1 year to 5 years, then again, the highest least add-on factor is interest rate contracts, then exchange rate contracts, then precious metals, and then equities, last other commodities. So if you're not able to remember the value, at least I will suggest you that remember the pattern. Okay, that which has the least, which has the highest. Now, under the add-on factor table, which contract carries the least risk for maturity above 5 years? So least risk is in any category. The least risk is for the interest rate contracts, because the interest rate somehow is dependent on the RBI, the monetary authorities. So these are least risky. Now, next is for the payment bank. This is important, huh? For the payment bank, for the, for the payment bank, as I've told you that there were different notifications that were released. So for the payment bank, it was said that the add-on factors will only be applicable for the exchange rate contracts and gold. So remember that which category of bank has only this exchange rate contracts and gold add-on factor. So it is the payment bank. Okay. So the add-on factors will improve the risk weight, and the add-on factors, they are basically able to calculate the potential future exposure, and the payment bank has only the add-on factor for the exchange rate contracts and gold. Now answer this question. Which of the following contracts have add-on factor that is relevant for the payment bank under CCR provisions, counterparty credit risk provision? So exchange rate contracts and gold. Coming to the next one, for contracts that are structured to settle. Now let's say the contract is for the 3-year time period. So the larger the time period, the higher the add-on factor, the higher the risk weight, basically, the higher the risk weight. But so 3 years means over 1 year to 5 years. So the higher the add-on factor. Okay. So the larger the time period, the higher the add-on factor. But now it has been said that, see, sometimes the banks, let's say Bank of India and Bank of America, they are coming into the agreement, the foreign currency, that Bank of India will purchase the $1 million of foreign currency after 3 years. Now, the Bank of India and Bank of America, they both are aware that what if the other party fails, or what if the other party cancels the agreement. So in this case, the Bank of India and Bank of America are saying that after every 6 months, the settlement will happen. So whichever is the gaining party will receive the money from the other party. So after every 6 months, the settlement of the gain will happen. So the amount, the $1 million will not be transacted. Only the gain or the losing part will be transferred so that the contract can be settled in the 6 months. So this is the idea that the total maturity of the contract is 3 years, but it has been decided that after every 6 months, the contract will be reset, the new value will be decided, and the older gain or the loss will be settled. So for contracts that are structured to settle the exposure following the specified payment dates where the terms are reset such that the market value of the contract is 0. So basically, Bank of India and Bank of America are basically saying that instead of coming into new contracts every 6 months, what we can do is we can have a long-term contract, and after every 6 months, we will do the settlement so that whichever is the gaining party will receive the money from the other party. This is the basic idea. So here the risk is, or the exposure is, for the 3-year time period or for the 6-month time period. What do you think? Yes, the risk is only for the 6-month time period. So that means the add-on factor will be for the 3 year or only for less than 1 year. add-on factor, the add-on factor will be 5 or 1. The add-on factor will be 1 only, 1% only. Okay? So this is the idea. I hope this is very much clear. So for contracts that are structured to settle on the regular basis, like say it can be 6 months, it can be 3 months also. Okay. For contracts that are structured to settle on the regular basis. So for these kind of contracts, the add-on factor will be on the basis of the reset that is happening. However, in the case of now, it has been specifically said that in the case of interest rate contracts which have residual maturity. So let's say interest rate contract is for the 2-year time period. And let's say the 6 months have passed. So how many months are left? How many years have left? Sorry, 1.5 years. So even though after every 6 months, the settlement will happen, that settlement will happen, but it has been clearly said that for specifically interest rate contracts, if the residual maturity is more than 1 year and meet the above criteria of the structured settlement, in this case, the add-on factor cannot be less than 0.50%. Okay. It cannot be less than 0.50%. So for the interest rate contracts, there is a special norm that even after the 6 months, the settlement is happening. But if the residual maturity is more than 1 year, then the add-on factor cannot be less than 0.50. Let's say the contract is for 10 years and the settlement will happen after every 6 months. 2 years have already passed, 8 years are left. In this case, the settlement is happening after every 6 months. So the 0.25% should be the add-on factor. But in the case of interest rate contracts, it has been specifically said that if the residual maturity is more than 1 year, then the add-on factor should be minimum of 0.50%. For more than 5 years, though 1.50 is the add-on factor, but because the regular settlement is happening, so the floor of the minimum of 0.50 can be used. Got it? No, it is not fixed. It is on the basis of the contract, and the different parties can do this kind of contract. If they don't want to do this, they don't have to. Basic idea. Okay. So basically, let's say two parties, Bank of India and Bank of America, they are coming into a long-term contract of 10 years. Now, both the parties knows that in 10 years, we don't know what will happen. Both the parties know that if we are gaining, the other party might take away or other party might cancel the contract. In this case, the 6-month time period has been decided that on 6-month time period, we will do the settlement. So for 10 years on 6-month basis, the settlement will happen so that whichever is the gaining party will get the money, whichever is the losing party will lose. So in the 6-month settlement will happen. So add-on factor will be on the basis of less than 1 year. But in the case of interest rate contracts, it has been specifically said that if the residual maturity, let's say 3 years have passed, 7 years are still left. So if the residual maturity is more than 1 year, in this case, the minimum add-on factor should be 0.50%. That is the idea. Yes, mark to market. Correct. Its settlement will happen on the basis of the contract size. Like the gain will be on the basis of the market price, na? That what is the price in the contract, what is the market price. Okay. Yes, correct. Ashwini. Any confusion now? Try to answer this question. Try to answer this question and then I will answer because this question is related to your concept only. So for an interest rate contract with maturity, the maturity is above 1 year. 1 year, more than 1 year is left. But they have periodic reset. What is the minimum add-on factor that is applicable? That is 0.50%. So even if the periodic reset is after every 6 months or after every 3 months, so actually the add-on factor, because the 6-month is the settlement or 3-month is the settlement, so add-on factor should be 0.25%, right? The add-on factor should be 0.25%. because the settlement is happening after 3 months, after 6 months. So add-on factor should be 0.25%. But in the case of interest rate contracts, let me go here so that you have better area. So basically, let's say interest rate contract is for more than 1 year. Okay, but the periodic settlement is happening 6 months. So add-on factor should be normally, as per the rule and regulation for the periodic settlement, add-on factor should be 0.25%. Okay, but because it is interest rate contracts and they are the special contracts, so even though periodic settlement is happening, doesn't matter. If the contract is the residual maturity is more than 1 year, then the add-on factor should be minimum 0.50%. Yes, Ashwini, got it. Let's say that for the equities, the contract is for 3 years. The contract has just started, so the residual maturity is also 3 years, but the 3 month or the 6 month is the periodic settlement. So what is the add-on factor that will be levied? Tell me very fast. What is the add-on factor that will be levied? 6%. 6%. Same contract. Coming to the same contract for the interest rate contract, the 3 years. The contract has just started. The periodic settlement will be after 6 months. So what is the add-on factor that should be levied? What should be the add-on factor? 0.5, because this is the minimum. Below than this, add-on factor cannot be levied if the residual maturity is more than 1 year. Got it now? Just let's finish this article, then we will take a break. Okay. Now, clearing member exposure, a bank acting as a clearing member of the SEBI recognized stock exchange. So see, the bank can work as a clearing member. Clearing member are basically the entities that clear and settle the trade in the stock exchange, okay. So a bank acting as a clearing member of SEBI recognized stock exchange for NSE, for BSC, in the equity derivatives and commodity derivative segment. So in the equity or commodity derivative segment, the bank is working as a clearing member for the clearing and settlement of the trade. So in this case, the bank has to compute and maintain the capital for the counterparty credit risk. In this role, why is it so? Because in this role, where the bank is a clearing member, it has to clear and settle the trade. It has to clear and settle the trade between the X and Y, let's say. So X and Y are doing the trade of the derivatives, equity derivatives or commodity derivatives. The capital market has to, the clearing member has to clear and settle the trade. Let's say in this role, the bank does not necessarily trade derivatives. The bank itself is not trading the derivative, but the bank is clearing and settling the trade on for the other entities. Now, what if, for example, if a client defaults? So X and Y, they came into an equity derivative contract or commodity derivative contract. Now these contracts are through the stock exchanges. So in the stock exchanges, when you are doing a contract, then there is a clearing member that clears and settle the trade. Now, what if you came into an equity derivative contract and the other party is defaulting? Who will take the responsibility? Can anyone tell me? Who will take the responsibility? Because in the stock exchange, this is the stock exchange. This is not the personal contract, right? So here the clearing member has to take the responsibility of clearing and settling the trade. So here, can we say that the clearing member has the risk? That what if the other party defaults? Yes, this is what is said here, that a bank, if it is a clearing member, that has to clear and settle the trade in the stock exchanges. So if a client defaults, the clearing member may still have to settle the trade, clear the trade, and that's why the bank as a clearing member also has the responsibility, has the obligation. Yes. Therefore, the RBI requires that even when bank is acting as a clearing member, it must still compute the counterparty credit risk. It must still compute the exposure and maintain the capital against that exposure. Okay. So while calculating the exposure in such cases for the equity derivatives or for the commodity derivatives, the requirement of the add-on factor will continue. Okay. So basically, even if the bank is not doing the trade itself, but it is a clearing member, it still has to maintain the counterparty credit risk buffers or the capital against the counterparty credit risk. So while calculating the exposure in such cases, this requirement ensures that banks maintain adequate capital against the potential risk that can come upon them. But this provision does not apply to payment bank, because the payment bank, they are not permitted to act as clearing member for the equity derivatives or for the commodity derivatives. Notional amount is the contract which the two parties have signed, na? Because X and Y, they have signed some contract. So whatever notional value is the value of the contract that they have signed. So multiplied by the add-on factor. Okay. Now, if a bank, let's say there is a qualifying central counterparty. Now what happens that X and Y are trading. So usually in the stock exchanges, there is a central counterparty. That is a third party, that is an intermediary that acts as a seller for the buyer of the contract and the buyer for the seller of the contract. Okay. So central counterparty is interposing itself. It is coming in between the two counterparties. So X and Y, they are the buyer and seller basically, but the central counterparty, it is the intermediary that is coming in between, acting as a seller for the buyer and buyer for the seller. So usually the central counterparty has the responsibility to complete the trade so that the trade completes between the two entities. Okay. So if a bank is a clearing member of a qualified central counterparty, there is a qualified central counterparty that is available. Qualifying central counterparty is an entity that is licensed to operate as a central counterparty intermediary between the two between the two people that are trading. So qualifying central counterparty is an entity that is licensed to operate as a central counterparty and is permitted by the appropriate regulator or overseer to operate as such with respect to the products offered. Basically, qualifying central counterparty is licensed to work as a central counterparty by the regulator. The permission has been given, and it is the central counterparty that is coming in between the two entities. Now, if a bank is a clearing member, the bank is a clearing member of a qualified central counterparty for its own trade. That means, let's say the bank A is doing the trade with bank B in the derivatives. There is a qualified central counterparty. In this case, what happens that the qualified central counterparty take some of the risk, because if the bank B defaults, then the qualifying central counterparty will have to complete the transaction basically. Okay. But what if the qualifying central counterparty also defaults? In this case, the clearing member has to take the responsibility, right? Bank A is the clearing member. So it is said that if the bank is a clearing member, which is also doing the trade in the derivative, so then it has to maintain it has to maintain capital 2% of the risk weight. So if a bank, let's read it again. If a bank is a clearing member of a qualified central counterparty for its own trades, like OTC derivatives, whichever trade it is doing. Okay. So there is a qualified central counterparty, that is bank A. It is also the clearing member for its own trade, and there is the bank B. Okay. The bank can treat its exposure to the qualified central counterparty as low risk, because if the bank B defaults, bank B can default, but the central counterparty will complete the transaction then. Central counterparty will take the responsibility. So there is a low risk because there is some central counterparty that is present to take the risk. Therefore, it is said that now this is a low risk situation. So the bank, but still some risk is available, that what if this central counterparty also defaults? So, but there is low risk because there are two different parties now. So the bank may apply only a 2% risk weight while calculating the capital. In this case, the add-on factor, the other formula will not be applicable. Only 2% of the risk weight will be applicable. Yes. Let me give you the example. Bank A, the State Bank of India, is the one that is the clearing member. Bank B, Punjab National Bank, they are coming into a contract, let's say, that is the equity derivative contract that has to be settled on 30th of May. There is a qualified central counterparty, CCIL, or the other any other party that is a third intermediary basically, that can act as a qualified central counterparty. Okay. Now, what if the Punjab National Bank defaults because it does not have the instruments or the money available, let's say. So in this case, the qualified central counterparty has to complete the transaction, has to, like, if the bank is buying the contract, so the qualified central counterparty has to complete the transaction. So there is no risk because the qualified central counterparty has to complete the transaction. But it is said by RBI that what if this intermediary defaults? Because it has gone under insolvency, it does not have money. So what if this party also defaults? Then it is said that the bank A has to maintain some capital with the risk weight of 2% against the risk weight of 2%. So failing of the qualified central counterparty is low. It is less risky. Okay, low risk is there because there is a qualified central counterparty, but still some risk is there. And so to acknowledge that slight risk, 2% of risk weight has been set. Okay. Sometimes the bank act as a clearing member for its client. Now, what is happening? Let's say there is X and Y. They are come. Okay. So let's say there is X and Y. They are coming into a equity derivative contract. There is a qualified central counterparty that has to complete the transaction, and the clearing member is a bank. Now, what if the Y fails? Who is responsible for completing this transaction? Qualified central counterparty. What if qualified central counterparty also defaults? Then who is responsible for completing this transaction, clearing this transaction? Clearing member. So it is basically said that even if there is qualified central counterparty that is present for your own trades or for the trade of the client, you have to maintain the capital against the 2% of risk weight. If the bank is legally responsible to clear the trade, if the qualified central counterparty fails. So this is the idea that bank clears through this. Let's understand. So bank clears its own trades through a qualified central counterparty. Okay, the bank clears its own trades through the QCCP. And here there is low risk because a qualified central counterparty is present. So risk weight is only 2%. Bank clears the trade for its clients. The bank is not clearing the trade for itself, but the bank is clearing the trade for its client. In this trade also qualified central counterparty is present. So bank is acting as a clearing member if the bank is legally responsible to compensate the client in case the QCCP fails. So bank will have to compensate. So the risk weight is 2%. If the bank is not, let's say there is a document that has been signed that the clearing member has said, because the qualified central counterparty is present, so clearing member can come into a contract that it will not be responsible. It will not be legally responsible. So if it has that contract that it is not legally responsible, then no risk weight, then no risk. No, qualified central counterparty is different. Clearing member is different. Clearing member is a intermediary of a clearing corporation. Vaishvi, it is usually the bank that is deciding that it wants to become the clearing member or not. The RBI do not force any bank. It is a business decision that you want to become a clearing member to earn the extra money. As per the prudential norms, where a bank acts as a clearing member of a QCCP for its own purposes, for its own transaction, a risk weight of how much shall be applied to the bank's trade exposure to the QCCP. Or when the bank is acting as a clearing member and it is legally responsible in the case that the bank is acting as a clearing member for the client A, for the client B, and it is legally responsible that if the QCCP fails, then what is the risk weight for the clearing member? 2%. Okay. No, it is available for all the derivatives. Forward derivative was the example. We have seen now that there are also like stock exchanges and such for all the derivatives, like for OTC derivative transaction, exchange traded derivative transaction also. So OTC derivative transaction, they are the forward contracts, swaps. Exchange traded means futures, options, securities financing transactions. Okay, for all these kind of transactions. Now, any confusion, anyone? Let's do one more, then we will take a break of 2-3 minutes. This is just one page document. So like the one page notification. So you will not be much forced here to study more. Let's just do this one. Okay. So foreign exchange management, export and import of currency amendment regulations 2026. So basically under the foreign exchange management, passengers that are the basically the foreigners that are coming into our country, they are bringing their foreign exchange above certain limits. They were already required to declare it to the customs. However, there was no formally prescribed standard format within the regulations itself. That's why the RBI has now inserted a standardized form, currency declaration form, that has to be filled by the passengers that are coming into our country. This provides an official standard format for the declaration that how much foreign exchange they are bringing into our country. So currency declaration form is not required to be filled if the total foreign exchange that is brought into India does not exceed $10,000, okay, through the cash that they are holding or the traveler's check, let's say check they are holding. So if they are bringing total foreign exchange of 10 up to $10,000, so they are not required to fill any form. And if they are bringing the foreign currency in the notes, that is in cash only, so they are not required to fill the form up to $5,000. So basically, before there was no set format. Now the RBI has said that the currency form will be provided. There will be a currency declaration form that will be provided, and you have to fill the currency declaration form. You will not be required to fill the currency declaration form if you are bringing the total foreign exchange of 10,000 up to $10,000 only, and if you are bringing the cash of up to 5,000 only, then you will not have to fill the form. But if you are bringing more than this, in the total foreign exchange more than 10,000 or in the cash more than $5,000, then you will have to fill the currency declaration form. Through this, it has been very nicely said that the CDF is required or not required. Okay. Chalo. Very easy. I think there should be no problem in this particular article. Try to answer this. As the Foreign Exchange Management Act Amendment Regulations 2026 issued by the RBI, the currency declaration form is not required if the total foreign exchange brought into India does not exceed $10,000, and in the cash it should not exceed, in the cash it should not exceed 5,000. Very good. $5,000. Any confusion? Clearing member and the QCCCP, they get some percentage in the benefit, okay, or they get some fees from the clients, okay. Any confusion? What benefit does this have? What benefit does this have? Basically, set format. The RBI wants to get the knowledge into set format. This provides an official standard format for the declaration. That's all. Total foreign exchange, it can be in the form of cash that you are bringing, the dollars, the notes that you are bringing, or the traveler's check, the check you are bringing. So total foreign currency can be brought in the form of cash as well as the traveler's check. While the 5,000 limit is only for the cash. It is only for the cash. Now, I hope this is clear that this $10,000 dollar limit, it is for the traveler's check, the cash, any other form of money that is being brought into the country. $5,000, this is for the cash only. Got it? Chalo. Now the next is unique identifiers that we are going to discuss. Just take a break of 2 minutes and be back. Okay. 10,000 includes total foreign exchange, that is cash also. Just 2 minutes break. Right now it is 8:13. We will meet back at 8:50. Chalo, shall we proceed now? Any confusion, anyone till now? Yes, correct, Akshara. Now coming to the master action, Reserve Bank of India unique identifiers in financial markets direction 2016. Okay, 2026. So unique identifiers in financial markets. So see, identifiers such as the legal entity identifier, unique transaction identifier, they are the key global standards which are recognized by the regulators around the world. And they provide the transparency. They promote the transparency in the financial market. So if a transaction is happening between Kavya of India and John of US, so in India and the US, how the information will be how the regulators will be aware about these kind of transactions. So there is the legal entity identifier that basically, or the unique transaction identifier that can help in identifying the transactions. This we will understand better in the coming slides. So identifiers such as legal entity identifier, unique transaction identifier, they are the key global standards for promoting transparency in the financial markets. Now, the Reserve Bank has mandated the implementation of the LEI and UTI for the transactions in financial markets that is regulated by it. Which financial markets are regulated by RBI? Which financial markets are regulated by RBI? Money market, that is the short term, for the short term financial instruments, like the interbank lending that is happening, overnight interbank lending, or for the short period of time, the interbank lending that is happening, that comes under the money market. The Reserve Bank of India also regulates the government securities market, the foreign exchange market. Okay, so these are some of the markets that are regulated by the Reserve Bank of India. So RBI has said that in all the markets that are regulated by me, there is the compulsory LEI and UTI that should be used. What is this LEI? What is this UTI? You will understand this in detail, but basically it has been said that these are the identifiers. Like Aadhaar card is the identifier for you. It is your identity, basically. Aadhaar card, it helps in identifying a person of India, a citizen of India, a person of India. Okay. So Aadhaar number is a unique number that a person has, identifying the person as a citizen of India. So similarly, LEI is the legal entity identifier that helps in identifying the entity, that is engaged in the financial transaction. Unique transaction identifier, it helps in identifying a particular transaction. So RBI has said that these identifiers are mandatory. They have to be used for the transactions that are happening in the financial markets regulated by RBI. Okay. Now, legal entity identifier, starting with this LEI code, legal entity, like we have a PAN number. So what is the requirement of LEI? If you want to recognize the entity, use PAN. Like, why cannot we use the PAN number? Because the PAN number, can we say that the PAN number is recognized all over the world? Can we say that the PAN number is recognized? No, PAN number is specifically for Indian use case, right? PAN number is the number that we use in India. But LEI, it is according to the global standards. It is according to the global standards. That's why it has been said that if the financial transactions are happening by the entities, legal entity identifier, it identifies the entity that is engaged in the financial transaction. Let's say XYZ entity of India is doing the transaction with ABC entity of US. So how are we able to identify these entities? Through the legal entity identifier. Not only in India, but abroad also, our entities are identified through the LEI. Okay? So this is the idea that the entities, like how much exposure this entity has, how much loan it has taken all over the world, how can it be known? Through the LEI. Because if you just put the LEI number, you will be able to see the transactions that an entity has done, or basically the entity was involved in what areas. So this is how the LEI is used at the global level. Who manages LEI? We will come to that. We are just starting with LEI. Do not worry about it. Okay. So LEI code is a 20-character unique identity code assigned to entities who are parties who are engaged in the financial transactions. This has been conceived of as a key measure to improve the quality and accuracy of the financial data systems for better risk management. Because if an entity, let's say it has taken loans from US, it has taken loans from the entities of UK, it has taken loans from the entities of UA, and the other entities that are giving the loan, they are not aware that how much loan this entity has taken, how much exposure this entity has. And this entity is just taking the loans and closing down after that, running away with the money. That should not happen, right? That's why through the LEI, the transactions are recorded that an entity is doing at the global level and at the country level also. So this LEI becomes very important. One LEI for one entity, like your one Aadhaar number for one person, okay? That's why it is said, na, it is a unique identity code. So LEI code is a 20-character unique identity code assigned to entities who are parties to a financial transaction. This has been conceived of as a key measure to improve the quality accuracy of the financial data. So LEI is unique. Every LEI is unique. It can represent only one entity. Each entity's LEI code connects to verified reference information from authoritative local sources. So basically, if you put the LEI code, it will provide you the information about the entity from the authoritative local sources, including the entity's ownership structure, which is accessible in the global LEI index. In this way, LEI answers the questions that who is who, which is the parent entity. Is the parent entity from Pakistan? Is the parent entity from such countries that we do not want to engage with or something? So who is who? Who owns whom? Okay? Who is who and who owns whom? It is easily recognizable. So LEI code shall be applicable to all the OTC transactions. Over the counter transactions means these are the transactions that are not happening through the stock exchanges. If the interbank lending is happening in the money market, is it through the stock exchanges? No. If the government securities transaction is happening, is it through the stock exchanges? No. So LEI code, so basically, let me give you an example that, see, the Reliance Geo Geo Financial Services, it has recently become a NBFC. So it is doing the financial transactions. So it has got a LEI code also. It has been given a LEI code. Who gives the LEI code? That we will come to. Like that we will come to. There is an entity that gives the LEI code that we will come to. So LEI code has been allotted to the Geo Financial Services because it is engaged in the financial transactions. So through this LEI code, we will be able to see that, okay, who is the parent entity of this Geo Financial Services? The Reliance Group or the Reliance Industries is the parent entity. So who owns whom? We are able to see that, okay, this entity, Geo Financial Services, is related to the Reliance Industries. It is under the Reliance Group. And we are also able to see that what transactions it is doing, how much exposure does it have, how much risk it is taking, how much of the international transactions is it doing with the other entities. So who is who and like who is who through the LEI, we are able to see. See, it's the same name of the entity. One entity can be of other entity also. Can we get confused? Yes. So through the LEI code, we are able to recognize the different entities and we are able to see the parent structure also. Got it now? Yes, LEI is a code that is given. Let's say a code is given to me. Do you know that through the PAN, your income history can be seen? Same is the idea here also. Through the LEI, your transaction history can be seen, as well as from the local authorities, the reference information can also be verified. So LEI code shall be applicable for all the over-the-counter transactions. So over-the-counter transactions are basically uh, the transactions that are not done through the stock exchanges, like the money market transactions. That is the interbank lending that is happening, or the lending between the financial institutions. The government securities transaction, it also does not happen through the stock exchanges. The foreign exchange transactions, or the over the counter foreign exchange derivatives, or the other derivatives, okay, that are not happening through the stock exchanges. So LEI code shall be applicable to all the over-the-counter transactions undertaken by entities other than individuals, because LEI is for entity only. It is not for individuals. It is only for the entities. So LEI code shall be applicable to all the over-the-counter transactions that are not happening through the stock exchanges. And for the government securities over-the-counter transaction, money market over-the-counter transaction, foreign exchange instruments, derivatives that are over-the-counter transactions that are not happening through the stock exchanges. So derivative transactions, all these transactions, all these derivatives also come under the LEI, like under this regulation, for which LEI code has to be given if there is the OTC transaction that is happening. So for all the entities that are engaged in the financial transaction, such as the over-the-counter transactions, that are the money market transaction, government securities transaction, foreign exchange instruments, derivatives, for all these transactions, over-the-counter transactions, LEI code has to be given. There is some particular point that you have to keep in mind, that for users or clients that are undertaken, for basically the entities that are undertaking non-derivative foreign exchange transactions, non-derivative foreign exchange transaction, for such entities that are undertaking non-derivative foreign exchange transactions, the LEI code shall be applicable only for transactions that are equal to or higher than $1 million. So for non-derivative, like for all the other transactions, for all the OTC transaction, LEI code has to be given. But for the non-derivative foreign exchange transactions, the LEI code shall be applicable only for such transactions that are equal to or more than $1 million. Okay? If the transaction is not over the counter, that means it is happening through the stock exchange. If it is happening through the stock exchange, then it is the responsibility of the SEBI, not RBI. ठीक है ना? OTC transactions are what? OTC transactions are those transactions that are not happening through the stock exchange. So all the OTC transactions that are under the regulation of the RBI, money market transaction, government securities transaction, foreign exchange transaction, derivative transactions that are over the counter, for which LEI has to be given. If the transaction is happening through stock exchange, that will come under the SEBI. Okay? Over the counter transactions are those transactions that are not happening in stock exchange. Any transaction that is not happening through the stock exchange, that comes under the over the counter transaction. Now another question, non-derivative means foreign exchange transaction. I am giving you $1,000. You give me 1 lakh rupees. This is non-derivative. It is not related to any derivative that future may payment hoga, the future payment will happen. So it is not a derivative transaction. So foreign exchange transaction, that is not a derivative. That will not happen in future. That will not be a future contract, forward contract, swap contract or something. So non-derivative foreign exchange transaction, I'm giving you $1,000. Give me 1 lakh rupees or something. So this kind of transaction, immediate transactions, basically we can say, LEI is not required for them if the transaction is up to $1 million. But if the transaction is equal to 1 million or more than 1 million, then the LEI will be required. I hope this is clear now. So for users or clients undertaking non-derivative foreign exchange transactions, the LEI code shall be applicable only for transactions involving an amount equal to or more than $1 million. In this case, LEI will be required. Chalo. LEI ensures that each entity involved in a transaction is clearly, uniquely identified, avoiding confusion due to similar names or structures. So we are able to see that who is who, which entity is actually involved, because the names can be same, the structure can be same. So who is who can be recognized through the LEI code, because that is a unique code. Try to answer this. If there is any confusion, kindly ask me. No, here non-derivative foreign exchange transaction has only been said. Non-derivative for foreign exchange transaction, only in such transactions, okay? Under the RBI directions on unique identifiers in financial market, in case of non-derivative foreign exchange transactions. LEI is required only for transactions that are equal to or exceeding $1 million. Okay. Yes, both parties. LEI is required for all the parties. Framework for implementation of LEI. So all participants, resident, non-resident, we have discussed now. Money market transactions, interbank lending that is happening, government securities transaction, the foreign exchange transactions, the derivatives, that is the forward contracts, the future contracts, the foreign currency forward contracts, the interest rate forward contracts, the different contracts that are happening. So these are the contracts over the counter, let's say. Not future contracts, sorry, only forward contracts are over the counter. Forward and swaps, they are over the counter, okay? So they are the non-derivative. They are the non-derivative. Money market contracts, government security, money market transactions, government security transactions that are happening on the immediate basis. You are buying the dated government security or treasury bill. The foreign exchange transactions, they can be non-derivative. Okay, they are non-derivative. Correct. Now, all participants, resident and non-resident, undertaking transactions falling within the scope of these directions shall obtain an LEI code. So, if you are doing the money market transaction, if you are doing the government securities transaction, if you are doing the derivative transactions, you have to give, as an entity, you have to give what? You have to give what? If you are doing the money market transaction, interbank lending is happening, government securities transactions, you are buying the dated securities or you are buying the treasury bills, the derivative transaction is happening. Okay, so what you have to give? LEI you have to give. You have to give LEI. As an entity, you will have to give LEI. There is a non-derivative foreign exchange transaction that is happening of $1,000. Do you have to give LEI? No. For the non-derivative foreign exchange transaction, LEI is only required for 1 million or for more than $1 million of transaction. Okay. This is the idea. All participants, resident, non-resident, undertaking transactions falling under these directions, they have to provide the LEI code. An LEI code has to be obtained from local operating unit, which is accredited by the Global Legal Entity Identifier Foundation. In case of LOU in India, in case local operating unit that is providing the LEI code, if it is in India, it has to be recognized by the RBI under the Payments and Settlement System Act 2007. So as I've told you that there is an entity that is providing the LEI code. So if Geo Financial Services wants to have a LEI code to do financial transactions, it basically has to take the LEI code from the local operating unit, which is accredited by the Global Legal Entity Identifier Foundation. Non-residents that are not legal entities. So non-residents, if they are not entities in their country of incorporation, let's say the funds operated by a mutual fund parent or management company. So like the mutual funds that are managed by the asset management companies, basically. So mutual funds, they are not directly the legal entities, okay? Or the foreign portfolio investors, they are not the legal entities. So non-residents that are not legal entities, but they are doing the financial transaction in our country, they can use the LEI code of their parent or management company. Entities involved in responsible for executing transactions, reporting, or for depository functions in the markets regulated by RBI shall capture the LEI code of the transacting participants. Basically, whichever entity is reporting the transactions or recording the transaction. So this entity has to take the LEI code. So if a entity is responsible for executing transactions or reporting or taking the record of the transaction, it has to record the LEI code of the transacting entity. Entities without an LEI code shall not be eligible for doing the financial transactions regulated by RBI. Okay. In the markets regulated by RBI. So entities without an LEI code, they will not be eligible to undertake the financial transactions in the financial markets regulated by RBI. Entities shall ensure that their LEI code is considered current, updated under the rules of the global LEI system. Now coming to the UTI. The Reserve Bank of India has now decided to mandate a unique transaction identifier for all specific derivative transactions carried out over the counter market. Now, over the counter market is basically over the counter market. Yes, there is the local operating unit now that issues the LEI code in India. So now coming to the over the counter. Over the counter transactions are those transactions that are not happening through the stock exchanges. Okay. So unique transaction identifier, it has been particularly said that the unique transaction identifier, it will help in identifying the transaction. It will help in identifying the transaction that is the over the counter derivative transaction. Okay. So Reserve Bank of India has now decided to mandate unique transaction identifier for all derivative transactions that are happening over the counter. That means they are not happening. If the derivative transaction is not happening through the stock exchange. See, if a derivative transaction is happening through the stock exchange, the records are being maintained in the stock exchange. But if the derivative transactions are happening over the counter, that is through some electronic trading platform, through personal basis, if the derivative transactions are happening, that means there is no proper transparency that is maintained, or there might be some lack of transparency. Okay, so that's why UTI has been mandated. So at present, all the transactions in the over-the-counter markets for the rupee interest rate derivatives forward contracts, basically for the derivative contracts, that are happening over the counter, all these transactions, they have to be reported to the trade repository of the CCIL. So all the over-the-counter derivative contracts, they have to be reported to the trade repository of the Clearing Corporation of India Limited. But now it has been said that to be very clear about the transactions that are happening, so UTI is mandated that each transaction over the counter derivative contract, each transaction that is happening over the counter derivative, so for each contract there should be a UTI, unique transaction identifier. Okay. So we know about the OTC market. It is a market where derivative transactions are undertaken other than the stock exchanges. So stock exchanges, the transactions are not happening in the stock exchanges. So that means the transactions are happening over the counter. Okay. So unique transaction identifier, it is a unique identifier that uniquely identifies the OTC derivative transaction. Now the unique transaction identifier, this shall be generated or reported for all transactions in the OTC derivatives market. Now basically unique transaction identifier, it identifies the transaction even if Kavya and John of US and Kavya of India are doing the derivative contract. If they are coming into a derivative contract over the counter, for this kind of transaction also the UTI has to be taken or has to be provided. Okay, so this is the idea. Now the UTI it shall be generated in accordance with the UTI technical guidance issued by the Committee on Payments and Market Infrastructure under the Bank of International Settlement. Bank of International Settlement provides a platform to the central banks to cooperate with each other. Okay. So the the CPMI of Bank of International Settlement and the International Organization of Securities Commission that provide a platform to the securities regulator like the SEBI and such. Okay. So basically the CPMI of BIS and the IOSCO, they have developed the UTI technical guidance, and the UTI shall be generated in India for the OTC transactions in accordance with the UTI technical guidance that is issued by the CPMI of BIS and IOSCO in February 2017. As per the technical guidance that was released in February 2017. UTI shall be a maximum of 52 characters comprising of the legal entity identifier of the generating entity that has generated the UTI. So unique transaction identifier, it is the unique identifier that will identify the transaction that is happening over the counter derivative. Okay. So for the UTI will be a maximum of 52 characters comprising of the LEI. LEI is 20 characters or 20 digit code, 20 characters code plus the unique characters. Okay. So basically, UTI, it is a 52 character code that will uniquely identify the transaction, that is over the counter derivative transaction. Now, this UTI will consist of the LEI code of the entity that is generating the UTI for the transaction. Okay. So LEI code will be 20 characters, sorry, plus the rest of the 32 characters will be unique numbers or unique identifier, and shall be unique to a derivative transaction. So this is the idea. Any confusion, anyone? Yes, correct. LEI is for all the money market transactions. It is for the government securities transaction, foreign exchange transaction, derivative transaction. LEI is for the entities, to recognize the entities. UTI, it has a limited role right now because see, in Feb 2026 only, the UTI was launched. And right now, the UTI that we are discussing, so in Feb, you will not have to study it because right now we are studying it it was again discussed in March. Okay. So UTI is basically for the transactions that are only happening over the counter derivative transactions, only for over the counter derivatives, not money market, not government securities, not any other kind of transactions, only for the over the counter derivative transactions, the UTI is required. Okay. And it is for the transactions to recognize the transaction. So IOSCO and CPMI work together to enhance the coordination of standard and policy development and implementation regarding clearing and settlement and reporting. So basically, they work together to release this technical guidance and to coordinate. The LEI 20 character alphanumeric code that we have discussed. Okay. So this is the idea. Any confusion? For all the over the counter derivative contracts, for all the over the counter derivative transactions, UTI is mandated. UTI is a 52 character code with LEI code of the entity that has released the UTI. So LEI code will be of 20 characters. The rest of the 32 characters will be unique characters. Okay. So starting 20 characters should be the LEI code of the entity that has released the UTI. Now, which entity will release the UTI, that we will discuss. We are discussing fully in English. UTI is applicable to all the over-the-counter derivative transactions and is intended to enable regulators to obtain a comprehensive view. So yes, it is only for the over-the-counter derivative transactions. Correct. UTI remains unchanged throughout the life cycle of a derivative transaction. That is correct. One UTI will be for one transaction that will remain unchanged and shall have a maximum of 52 characters with LEI of the generating entity followed by a unique identifier. Correct. UTI shall be generated in accordance with the UTI technical guidance that is issued by the CPMI of BIS and IOSCO, not OECD. So this is wrong. So 1 and 2, A is the correct answer. Now, UTI generating entity shall be determined as per the waterfall with the responsibility of UTI. See, the responsibility of the UTI, generation of UTI will be first on the first level. If they are not able to generate the UTI, they are unable or unwilling to generate the UTI, the next level will have to generate the UTI. That is the idea. So first, for the over-the-counter derivative transaction, the central counterparty, if there is a central counterparty, that will have to generate the UTI. If it is unwilling to generate the UTI, then the electronic trading platform through which the transaction is happening, that will have to generate the UTI. If that is also not generating the UTI, or let's say electronic trading platform is not available, bank A, bank B, they are coming to over the counter derivative transaction by themselves. There is no central counterparty, there is no electronic trading platform. They are personally coming into the contract. In this case, the entity, as is mutually agreed between the counterparties. So these are the two parties of the transaction. These are the two counterparties. So let's say they both have decided that bank A will generate the UTI. So bank A will generate the UTI. If bank A is unable to generate the UTI, then the CCIL trade repository of the CCIL will have to generate the UTI basically. This is for the transactions that are reportable only in India. Only in India. The transaction is between the two entities that both belong to India. But let's say that the transaction is happening between Kavya and John. Kavya is of India, John is of US. Or the transaction is happening Bank of India and Bank of US. So Bank of India is of India, Bank of US is of US. So if the transaction is reportable in India as well as in other foreign jurisdiction also, in this case, the CCP, central counterparty, will have to generate the UTI. If it is not available, clearing member, if a clearing member is a counterparty, basically it is the clearing member is also a counterparty that is involved in the transaction. Okay? So let's say Bank of India is also the clearing member. And the Bank of US is the other party. So the Bank of India is also the clearing member. So the clearing member, if a clearing member is a counterparty to the transaction, then it will have to generate the UTI. Let's say it is not willing to generate the UTI, then the next ETP, electronic trading platform, will generate the UTI. If it is not able to generate the UTI, if a foreign jurisdiction has a sooner reporting timeline, that means the transaction happened, the over-the-counter derivative transaction happened, and for this transaction, let's say in US, the reporting timeline is that as soon as the transaction happens, within 2 hours, reporting should happen. While in India, it is said that as soon as the transaction happens, after that, within 24 hours, the reporting should happen. So reporting is sooner in India or US, where the reporting is sooner. In the foreign jurisdiction in US, the reporting is sooner. So in this case, the entity, as per the requirement in the foreign jurisdiction, that will generate the UTI. But let's say if the reporting is not sooner in US, it is 48 hours in US, while in India it is within 24 hours. So if the foreign jurisdiction does not have sooner reporting timeline, the entity, as is mutually agreed between the counterparties, between Bank of India, Bank of US, whichever counterparty is decided, let's say Bank of US has been decided, so it will generate the UTI. Or if they all have not generated, at last the responsibility will come on the CCIL trade repository. Why the CCIL trade repository is at last responsible? Because this is the entity that records the over-the-counter derivative transactions. So CCIL trade repository, they are the if a transaction is reported without the UTI, CCIL trade repository will have to generate the UTI. That is the last leg. If a foreign jurisdiction has a sooner reporting timeline, so which will generate the UTI? The entity, as per the requirement in the foreign jurisdiction, they have generated the UTI. So UTI has been generated by the foreign entity or the entity as per the foreign jurisdiction. Now, in case the UTI is generated by the foreign entity and the party involved in the transaction that was belonging from India is unable to take the UTI within the transaction, within the reporting timeline. Reporting timeline in India was transaction within 24 hours. So within 24 hours, let's say the Indian entity was not able to take the UTI to report the transaction. In this case, the transaction has to be reported with the interim or temporary UTI. With the temporary UTI, the transaction has to be reported. Now, why are we not doing that? Okay, foreign entity has created a UTI that will be used in the foreign jurisdiction, and a UTI can also be generated by the Indian bank to report it in India. Can we do so? Can we have two different UTI for one transaction? No, this is not allowed now. That's why if the foreign entity generated the UTI, the Indian bank has to take this UTI to report the transaction. But what if the Indian bank is not able to take the UTI within the reporting timeline of 24 hours? So that if Indian bank is not able to take the UTI within the timeline, then the temporary UTI, interim UTI will be created to report the transaction with the CCIL trade repository. And within 5 Mumbai business days from the date of the transaction, the actual UTI has to be informed. This is said by the RBI that you can use the temporary UTI. Maybe there is some problem from the foreign entity side which is not able to share the UTI. So, okay, it's no problem that you are making some delays, but it should not be delayed after 5 days. Within 5 days, anyhow, the market participant, the Party of India will have to take the UTI. Got it? Mumbai business days, basically we are transacting with the US UK, other entities now. So the business days on the Indian basis. Got it? It's not like we are taking the US business days, we are taking Indian business days, Mumbai business days. So for transactions that are reportable in India and in foreign jurisdiction, and the foreign jurisdiction has a sooner reporting timeline and they have generated the UTI, so market participant has to take this UTI as soon as possible within the reporting timeline of, let's say, 24 hours. But in case the market participant is unable to obtain the UTI within the reporting deadline, so interim UTI will be created to report the transaction, and within 5 Mumbai business days, it has to be taken. The UTI has to be reported, actual UTI. See, it is not our UTI. The UTI, it is as per the global standards. It is not our UTI. It is the UTI as per the global standards. So everywhere around the world, the UTI is of 52 characters only, with LEI of the generating entity and then the unique identifier. It's global. Now, can a UTI number be changed? Can the UTI code be changed for a transaction? No. In the general circumstances, UTI number cannot be changed. Okay. So even if the timeline has been changed for the contract, even if the amount of the contract is changing, if the two parties are still involved in the contract, the same UTI will be used. But let's say novation has happened. That means before party A and party B were involved in the contract. Now party B is cancelling the contract and is basically transferring the contract to the party C. So can we use the same UTI now? Because now the party has changed. Now a new UTI will be created. So only in the case of novation, where a new party has entered the contract, only in that case, new UTI can be generated. So basically, after reporting the UTI to the CCIL trade repository, new UTI cannot be created. But if a life cycle event is happening, that means novation has happened, new party has entered the contract, then a new UTI can be created because a new party is entering. Okay. So RBI has now decided to mandate UTI for all these over the counter derivative contracts, basically all the derivative contracts. This applies. The UTI is mandatory to the over the counter derivative contracts entered into or after January 1, 2027. Okay. CCIL has been made responsible to issue operating guidelines and reporting formats for UTI reporting. Now, Section A of the directions on implementation of the LEI shall come into force with immediate effect. That is, LEI has to be immediately be used and reported. Section B of the directions, that is about UTI, they will be applicable from January 1, 2027, because it has been said that they will be used from January 1, 2027. So LEI uniquely identifies the counterparties, entities. UTI serves as a single unique reference for the transaction. Novation basically means that the party is changing. Let's say Ritank and I am doing a trade, but Ritank is not able to continue with the trade. So he has asked Ashwani to do the trade with me. So basically, I and Ritank were doing the trade, but now I and Ashwani are doing the trade. So this is novation basically. Party has changed. Another party has changed. One part has changed. Correct. Now, Digital Payment Awareness Week. The 6th edition of the Digital Payment Awareness Week has been observed during March 9 to 13, 2026. Okay. As part of this initiative, Governor Shri Sanjay Malhotra launched the pilot program titled Awareness Program on Digital Payments. This is basically the Digital Payment Awareness Week to make the people aware about the digital payments. And the pilot program was launched. That was the awareness program on digital payments. This is conducted in Maharashtra. This program is conducted in Maharashtra in partnership with the CSC E-Governance Services India Limited. At the launch event, there was also the launch of the multimedia awareness campaign, Thoda Dhyan Se, that is be alert, be careful while doing the transactions. Not very important article, just the basic idea we needed to have. Now, coming to the NOP INR position of authorized dealers. Okay. So this is another small article that we have to discuss. So the session, what is the time right now? My mobile has got switched off. The session might go up to 9:30. Okay. So yes, the session will go up to 9:30. because today we also had the introduction part. So that's why a little more time will be required to finish the topics. And I want the topics to be finished. Okay. So as per the market direction, risk management, as per the market direction, that is amended from time to time, the RBI may prescribe limits for open position involving INR. What is this open position involving INR? Basically, let's discuss this first. So, open position involving INR. How many of you have heard about authorized dealers? Authorized dealers are basically authorized by the RBI to undertake the foreign exchange transactions, to undertake the buying and selling of the foreign exchange, of the foreign currency, right? So authorized dealers, they are authorized by the Reserve Bank of India to be able to buy and sell the dollars, to be able to buy and sell the dollars, okay, or other foreign currency like the euro and the other currency. Let's say you want to travel to US. From where you are going to get the dollars? From some bank? From some bank, right? So banks, they are the authorized dealer category 1. So authorized dealers, they are allowed to buy and sell the foreign exchange, foreign currency. That is the idea. Now, what happens? Let's say there is an exporter that is exporting the product to US. Okay. And US firms are paying to the exporter $10 million. Or let's say the exporter is getting $600 million, $600 million. Now this exporter is the Indian exporter. Can this exporter use the $600 million to pay the salaries, to buy the raw material in India? Can this $600 million be used in India? No. Exporter will be giving this $600 million to the bank and will be taking what? Rupees. Will be taking rupees for the transaction in India. That is the basic idea, right? So what has happened that long position basically means that the authorized dealer, the bank has got the foreign currency. That is the long position. They are buying the dollars. They are buying the foreign currency. So bank, that was the authorized dealer, that was authorized to buy or sell the foreign currency. So the exporter has sold the dollars and the authorized dealer has bought the dollars. Okay. So they have got $600 million. Let's say the foreign investors, they want to invest in India. Can they invest in the financial market directly in dollars or euro? No, they will. Basically, the foreign investors, they will sell their dollars to the bank. The bank will convert this dollars into rupees that can be invested in the Indian financial market. So US dollars have been received from the foreign portfolio investors. US dollars have been purchased from the exporters. How much is the total dollars that have been received, that has been bought by the authorized dealer? $750 million. This is the total dollars that have been bought. Now let's say that the importers, now the Indian importer want to import the machine for which it requires the $300 million. From where the importer is going to get the dollars to import the machinery? From the bank. So basically the bank will give the dollars to the importer and will get the rupees. Okay. So $300 million has been paid to the importer or to the travel. Let's say the people wanted to travel to other countries, so they have taken the dollars. Okay. So for your import or for your travel, you have taken the dollars. So this is the sale of dollars. That is a short position, deducting the amount from the bank. What is the net open position? What is the net open position? Open position basically means the in one day, we are talking about, this is a one day. In one day, how much money has come in, how much foreign currency has come in, and how much foreign currency has gone out. So this is the net open position. This is the open position that the bank has. Think about it, that if the multiple banks, they are keeping millions of dollars with themselves, that means they are not supplying much dollars in the market. What will happen? The demand of dollars is high, supply of dollars is less, because the banks know that today $1 is equal to 83 rupees. Tomorrow the $1 might be equal to 90 rupees. So bank are holding the dollars with themselves. If the bank keep on holding the dollars with themselves for the speculative purposes, so that tomorrow when the price goes up, they will sell the dollars then, or maybe they will hold on to the dollars. This is wrong, right? Because if the bank keep on holding the dollars, that means the supply of dollars is not sufficient in the market. If the supply is not sufficient, the price of dollars will start increasing. The value of dollars will start increasing. Dollars will appreciate and rupees will further depreciate. So RBI was seeing this, that okay, some of the banks were actually holding a lot of dollars. They were not supplying these dollars in the market even when the demand is high in the market. So RBI said that RBI has now decided that authorized dealers, they are allowed to buy and sell the foreign currency. They shall ensure that their net open position in India, in the INR position, that against the dollars, the rupees are being bought and sold. So net open position in the onshore. Onshore means in India. In India. Onshore means in India, not offshore, not in other countries. In India, in the Indian deliverable market, the net open position maintained within $100 million at the end of each business day. That means a bank, a authorized dealer cannot hold more than $100 million at the end of each business day. Got it? No, foreign exchange is only when the reserves are only maintained by RBI. If the banks are holding the dollars, now they are only doing it for the speculative purposes. Foreign exchange reserves are being held with the RBI. Okay. So how much the net open position is of the bank? What is the net open position of the bank? $450 million at the end of the business day. At the end of the day, the bank is holding $450 million. Bank can supply these dollars in the market. If the bank supplies these dollars in the market, the supply of dollars will increase. If there is too much supply of dollars in the market, the price of dollars will decrease. The value of dollars will decrease and the rupee will stop depreciating. So RBI is saying that supply these dollars in the market. So now RBI has said that a bank, a authorized dealer can only hold how much for a day? How much they can hold? Maximum they can hold $100 million. Maximum they can hold $100 million, or within $100 million they can hold. So action is that the banks have to sell, let's say the bank is selling $360 million. So how much is left with the bank? If the bank is selling $360 million, $90 million is left with the bank. Is it allowed? Is this under the allowed limit? Yes, this is allowed because they have to hold within $100 million. Now this 360 million that has been sold in the market, is it increasing the supply of dollars in the market? With the increase of supply of dollars, the value of dollars will be decreased, or at least the demand will be met for the dollars now. So that is the idea. So basically RBI was seeing that there was very high net open positions that the authorized dealers were having. So RBI said that in the Indian market, in the onshore means in the Indian market, the net open position should be maintained within $100 million at the end of each business day. Authorized dealers shall ensure compliance with the above at the earliest, but not later than 10 April 2026. So basically, this particular master direction, it provides the right to the Reserve Bank of India to set the limits for the net open position, And now the RBI has actually, limit was previously also, but now RBI has updated the limit. Any confusion here? Yes, RBI can penalize the banks now. There are penalties. Like every day, if you see RBI website, there are monetary penalties that are imposed. Okay. So Reserve Bank of India has capped the net open position of authorized dealer banks in the domestic market at which of the following levels? Yes, A is the answer. $100 million. Okay. Got it? Yes, they monitor it on the daily basis. There are limited authorized dealers now. Some of they are authorized by the RBI. Now, RBI can also cancel the authorization if they do not follow the rules and regulations. Okay? Chalo. Now we are coming towards the end of the articles. Just one or two articles are left. Just give me 1 minute. Till then, anyone has any confusion, kindly ask me. I I'm not able to see the comments of the YouTube students. So let me just check that and give me 1 minute. Till then, if there is any confusion, kindly ask me. Okay. In any transaction there, this was stated now. Who has asked the question? Tejas. Okay. Tejas, it was said now that LEI in the UTI, the 52 characters, the LEI will be used for the entity that has generated the UTI. Okay. So whichever entity is generating the UTI, it can be the CCP or the electronic trading platform, okay, that belongs to some entity or the counterparty. Whichever entity is generating the UTI, that entity's LEI has to be used. Got it? Demand. See, if there is more demand, if there is higher demand, supply is less. What will happen? If there is more demand, supply is less. High demand, less supply. So what will happen? Price will increase. Price will increase. Similarly, we have huge demand for dollars. Supply of dollars is less. What will happen? If demand of dollars is very high, supply of dollars is less. So price of dollars will increase. Dollar will appreciate. And rupee against the dollars, rupee will depreciate. So because we have so much of the demand of dollars and supply of dollars is less, that's why the price of dollars is high. Na? Chalo. Now let's finish these articles also. No further confusion. Nice. Very good. Chalo. So non-banking financial companies. Is there any problem that is coming in my voice? It is still fine, right? Okay. Chalo. Non-banking financial companies prudential norms on capital adequacy second amendment directions. Basically, what is owned fund? Any idea? For a NBFC, for a non-banking financial company, what is owned fund? What is owned fund? It is. It is. Acha, let's say that Kashish has earned 10,000 rupees. So can we say that this is the money belonging to Kashish? Can we say so? Yes, right? Similarly, owned fund is the fund that belongs to the NBFC completely. It is not borrowed money. It is not the deposited money. It is not to be returned. This is the owned fund. That is the money belonging to NBFC in the basic sense. Okay. Now, this owned fund consists of the paid up equity capital. That is the shareholders. If the shareholders have invested in the company. So this is the money of the shareholders or the company now. This is the money of the NBFC now because it has got the money. Okay, it is the company's funds now. It is the company's money. So paid up equity capital, that means the shareholders invested money. Compulsorily convertible preference shares. So the preference shares that will be converted into the equity. That is also basically the money belonging to the company now because the company has got the money from the shareholders for the shares that the people have purchased. The money has been invested in the company. Okay. So paid up equity capital, that is the shareholders capital that has been invested in the company. Compulsorily convertible preference shares that will be converted into the equity shares. Free reserves. Now, when we discussed from the profit, what are the three areas where the profit is divided? What are the three areas where the profit is divided? First, tax has to be paid. So that will become, first of all, profit after tax. After the tax has been paid, then there are two areas where the profit is divided. One is the undistributed profits. Undistributed profits, that is also known as the retained earnings. That is also known as the free reserves or the reserves of the, this also comes under the free reserves. Okay. Just a second. Let me see for the YouTube comments also. I'm not able to see it. Just 1 second. Chalo. Sorry. So profit after tax will go for the undistributed profits, retained earnings, as well as dividend. Okay. So free reserves, including the part of the profit. Okay. That goes. So free reserves means including the part of the profit that comes under the undistributed profit. Basically, this we will discuss when we discuss the formula. Okay. So free reserves it basically includes the profit, especially the undistributed profit that is kept with the company, because this is the money belonging to the company now. Okay. Share premium account means certain shares are sold at a premium value, so that premium value is included here. Capital reserves, now capital reserves basically represent surplus arising out of sale of assets. Let's say some asset has been sold at 100 crores, so the cost of the asset was 50 crores. So what is the reserve, or what is the additional value? Surplus. Basically 50 crores is the surplus. Okay. So capital reserves, it represent the surplus that has been earned from the sale of the asset, excluding the reserves created by revaluation asset. Let's say that the building of the bank was of 100 crores. Now it is of 120 crores. So 20 crores is the revaluation that has happened, right? 20 crores is the higher value. Can we include it in the owned fund? No. Why? Because we are not selling this branch. We are not selling this building now. So basically, it has been said that if we are doing the revaluation of asset, that means the asset value has increased, but it has not been sold. So we cannot include it in the funds because the asset has not been sold. The revaluation will not be included in the funds. Okay. So capital reserves represents the surplus that has come from the sale of asset, excluding the reserves created by revaluation of asset, because these assets have not been sold, the valuation has just increased. Now this is the owned fund. This is the fund that has been received by the NBFC, and it has become the funds belonging to the NBFC. The money they have received from the shareholders, the money they have received in the form of profit as undistributed profit and such. Okay. Now, what you have to deduct? Losses you have to deduct, revenue expenditure you have to deduct intangible asset. That means the patents or the brand value. They are intangible asset. Okay. Their value cannot be determined completely. That's why their value has to be deducted. So own fund, this is the basic formula of own fund. Basically, you can understand own fund is the fund belonging to the NBFC to absorb, and these funds can be used to absorb potential losses and safeguard the depositors and investors. So basically, own fund is the fund belonging to the NBFC that can safeguard the NBFC from any potential distress. Now, owned fund, Now, see, this is given in the master direction that came under this notification. So basically, the NBFC, any NBFC should have a minimum net owned fund of 10 crore. Okay. The minimum net owned fund requirements for specialized NBFCs, such as NBFC Infrastructure Finance Company is 300 crore, Infrastructure Debt Fund is 300 crore, Mortgage Guarantee Company is 100 crores, Housing Finance Company is 20 crores, Standalone Primary Dealers. This is the minimum net owned fund that the company should have. Why the NBFC should have the minimum net owned fund? So that they are able to have these net owned funds so that they can handle the distress, because this is the funds owned by the company that belongs to the company that can be used during the distress situation also. Okay. So that's why there are certain minimum net owned funds that have been laid down for the different companies. Okay. So this is like we will be discussing about different NBFCs. So this is just the net owned fund that you have to keep in mind. Now coming back. Okay. So earlier what happened that when we talk about this free reserves, when we talk about the free reserves, we take the profit of the past financial year, and we see from the profit that what is the retained earnings. that the company is keeping. So that we included in the free reserves. So in the past year, in the previous financial year, whatever is the undistributed profit, undistributed retained earnings, that we include in the free reserves. Now RBI has said that the quarterly data is also released. The quarterly profit is also announced by the NBFCs. So from the quarterly profit, also the dividend is also paid out sometimes, and the undistributed profits or the retained earnings is also being kept by the NBFCs. So why these undistributed profit from the quarterly profit is not added in the free reserve? So previously what was happening, that your yearly profit was seen to include the undistributed profits or the retained earnings in the free reserves in the owned fund. So because this is the money that is going to the company, this is the retained earnings for the company, part of the profit that is going to the company. So only for the yearly profit this was done. Now the RBI has said that because the quarterly profit is announced by the NBFC, so from the quarterly profit also, whatever profit that is retained by the company, that should also come under the free reserves, that should also come under the owned fund of the company. Making sense? That is all. That is all the point here. Okay. So earlier interim or quarterly profits of the current financial year were not considered. Only the profits of the past year were considered for the inclusion in the owned fund under the free reserves. That includes the undistributed profit. Now the quarterly profits of the current year, they will also be, or the quarterly profits from the current year can also be included under the free reserves. The undistributed profit, basically from the quarterly profit, undistributed profit can be included in under the free reserves under the net owned fund. As a result, capital adequacy calculations largely relied on previously audited reserves. So basically, and the capital adequacy ratio also in the CRAR, when we talk about the tier 1 capital, the common equity tier 1 capital, that also includes the free reserves, that also includes the undistributed profit. So that was also being calculated on the basis of the previous profits and the previous undistributed profit. Now it has been said that the current quarterly profit from this, whatever is the undistributed profit, that should also be coming under the common equity tier 1 capital, that should also be coming under the owned fund. Owned fund will be updated quarterly. It is calculated. You can calculate it on the daily basis also, but it will be updated quarterly. Any confusion here, first of all? So the RBI has now allowed current year quarterly profits to be included in the free reserves, and has also clarified about the right of use that we will discuss later on. So this change, basically, regarding the quarterly profit, this change by the RBI will be applicable to NBFCs, including housing finance companies, core investment companies, mortgage guarantee companies, and asset reconstruction companies. For these companies, do remember the net owned fund. Okay. Now, free reserves including quarterly profit. So inclusion of quarterly profits shall be subject to certain conditions. First of all, the quarterly profit should be audited or reviewed on a quarterly basis. There should be statutory auditors that should audit it so that it can be seen that actually the company has earned the money or not, actually the profits have been earned or not, or the company is just putting out some random number. So basically, the quarterly profits can only be included in the free reserves, especially the undistributed profits that is kept by the company itself will be included in the free reserves only after the review or the audit has been done by the statutory auditors for the quarterly profit. Now, such profit shall be reduced. This is why I was again and again saying, see, RBI first said that in the free reserves, we will include the quarterly profit. But think about it. Quarterly profit, can it be completely included in the free reserves? We are talking about the net profit, basically, the quarterly. Can we include the quarterly net profit? Net profit is basically the profit after tax. Can we include this whole quarterly profit after tax in the free reserves, in the owned fund, or in the tier 1 common equity tier 1 capital? We know now that from the profit after tax, dividend has to be paid. So this is not owned fund of the company. This is not owned by the company. So that's why I was again and again saying that you have to only consider the undistributed profits that are kept by the company in the owned fund. So this is clarified by the RBI also, that such profits that are the quarterly profits, that are the quarterly net profits, quarterly profit after tax basically. So the quarterly net profits, they shall be reduced by average dividend paid in the last 3 years and the amount which can be reckoned. So basically, now how we will calculate? See, sometimes the company do not pay quarterly dividend. So how are we able to see that what is the quarterly dividend that can be paid from the quarterly net profit? What is the quarterly dividend? So to see the quarterly dividend or to estimate the quarterly dividend, it has been said that take the average of the dividend paid in the last 3 years and multiply it with 0.25. Multiply it with the 0.25 to see for the, like there are 4 quarters in a year now. So basically divided by 4. Take the dividend. So basically take the dividend for the past 3 years on average. Take the average dividend past 3 years. Now for seeing the quarterly data divided by 4. Should we divide it by 6? Should we divide it by 6 or 2? No, na. Why are we dividing it by 4? Because there are 4 quarters. There are 4 quarters and we want to see the quarterly data. We are talking about quarterly data. Okay? So average dividend in the past 3 years. See, from the, so basically I hope this is clear now that quarterly net profit, to include the quarterly net profit in the owned fund under the free reserves, basically we have to first deduct the dividend, the quarterly dividend. Now we do not know the quarterly dividend because usually company do not give the quarterly dividend. So in this case, what we will do, we will take the average of the dividend in the past 3 years and we will divide it by 4 to see the quarterly, to estimate the quarterly dividend. And this quarterly dividend will be deducted from the net profit that is earned in the quarter. So the net profit earned in the quarter, deduct it, the net profit earned in the quarter. Let's say the quarterly net profit is 100 crores. Okay. Deducted with the quarterly profit, that is basically the 0.25% or 0.25 multiplied by the average of the dividend on the past 3 years. So this is estimate of the quarterly profit. So deducted with the quarterly profit, let's say 25 crores. So what will be the undistributed profits? So from this quarterly net profit, we have given the quarterly dividend estimated at 25 crores. So what is left? 75 crores is left. This is the whole thing that is given in the formula. So basically eligible profit that can be added, the eligible profit from the quarter that can be added in the owned fund is the net profit deducted by the average of the dividend in the past 3 years taken for the quarter. Any confusion here? Thank you so much, Aditya. Means a lot. We will see that. No confusion? This was all. Okay. So eligible profit basically from the quarterly net profit. They could have just said undistributed profit. I don't know why they made it so complicated. So from the quarterly net profit, basically only the undistributed profit can be added in the owned fund in the tier 1 capital, in the common equity tier 1 capital. And because the dividends are paid out to the shareholders, it is not owned by the company now. So from the quarterly net profit, that is the eligible quarterly net profit, from this you have to deduct the dividends. How you are going to deduct the dividends? Because we don't know the quarterly dividends. So we take the average of the 3 years of the dividend divided by 4 to see it for the quarter, that is basically multiplied by 0.25. And we have the eligible profit, that is this. So quarterly net profit minus the dividend, quarterly dividend. So we have the undistributed profit. Eligible profit, that is the undistributed profit that is owned by the company. This T is for quarters only, nothing much. Chalo. Losses in the current year shall be fully deducted from the owned fund. So losses in the current year will be deducted from the owned fund. No, formula-based question is not expected. It is not usually seen, but they can ask you such question that, see, the key changes introduced by the amendment. So I will show you the question also, that what kind of question can come. So inclusion of quarterly profits in the free reserves. Quarterly profits can be added in the free reserves now. This is allowed while calculating the owned fund, as well as for the tier 1 capital also. This has been allowed. Condition is quarterly, first for the quarterly profit, the audit has to be done, and then from the entire quarterly net profit, from the entire quarterly net profit, from this net profit, deduct the fraction of the average dividend paid last 3 years. Okay. So that is the idea, to see the eligible profit that can be added in the free reserves in the owned fund. Try to answer this now. The RBI has given this formula, so all the banks will have to use it. Sorry, all the NBFCs will have to use it. Now, with reference to NBFC prudential norms, quarterly profit of the current financial year is considered while calculating owned fund. Is it? Yes. Previously, it was not. It only the profit of the previous financial year, the whole year, were used for the owned fund. But now, quarterly profit can also be used for calculating the owned fund. Losses in the current year shall be completely, fully deducted from the owned fund. Only quarterly profit earned after adjustment. So quarterly net profit after adjustment for a fraction of the average dividend paid during previous 3 years. So that is, let's say, the quarterly dividend basically. So dividend for the past 3 years. So then we can get the eligible profit that will go under the own fund. Yes, absolutely correct. So 1 and 3 are correct, and that's why the right answer is D. Chalo. Now, another article I said that will be regarding the right of use. But before that, see, in the standalone primary dealers also, this is another direction that has been released by the RBI. Same thing has been said in this also, that for the standalone primary dealers, now in the tier 1 capital, for the calculation of tier 1 capital, how the tier 1 capital is calculated, here we take the paid up capital again, the shareholders' money that has been invested in the company, statutory reserves, that are the reserves that the company is holding, the money that the company is holding by selling the capital and such, other disclosed free reserves, including quarterly profit. Same formula will go here also. That is the eligible profit that will be earned in the tier 1 capital is basically the net profit of the quarter minus the 0.25 multiplied by the average of the 3 years dividend. I don't think that I have to state everything again. Is there any requirement? The same formula, the same everything, just instead of owned fund, in the standalone primary dealers case, tier 1 capital has been mentioned. In the tier 1 capital also, the formula is this. Tier 1 capital is basically the most liquid capital that the bank has, that consists of the paid up equity capital, statutory reserves, free reserves, deducted by the investment that the standalone primary dealer is doing in the other subsidiaries, intangible assets that are the patents or the brand value, losses, all of this has to be deducted. Deferred tax asset means in the future the asset will be there, tax asset will be there and something. So this is the idea. So in the tier 1 capital, the quarterly profits can be added in the free reserves by taking the formula that we have already discussed. Now coming to this, further RBI has instructed that if the NBFC incurs losses, that will be deducted from the owned fund, basically. Coming to the last article or the last part that we have to discuss, and 1-2 more points that we will be discussing. So amendment also brings a change. See what happens basically for the mortgage guarantee company, for the core investment company and housing finance companies. For these companies, if they are taking any tangible asset, physical asset on lease, they have the right of use. Now they do not have to deduct this asset from their owned fund. So basically, if the mortgage guarantee company, if the housing finance company or the core investment company, if they are taking any tangible asset means physical asset basically, on lease for a time period. Of course, lease is for 10 years, 15 years, 20 years, sometimes 100 years also. So if they have taken any physical asset on lease and they have the right of use of this physical asset, So they do not have to deduct these physical assets. They do not have to deduct these physical assets from their own fund. Any confusion here? Any confusion? Yes, but still it has been said, because even if it is on lease, the right of use is with the company. That's why it has been clarified. For the for the mortgage guarantee company, for the core investment company, housing finance company, there were different notifications were released, but the same statement has been given that these companies, they shall not be required to deduct the right of use asset that is taken on lease from the own fund. It has not to be deducted. That's it. So in general, while calculating the own fund, certain assets are deducted, but if the right of use, the lease is there, and the physical asset is there, then it has not to be deducted. I know there are okay. This additional information I will share with you in the next session. This is something that comes from the static, but we have seen some questions. Like in the last year, in the phase one, there was a question that the NBFCs can invest in the NBFCs. Like the question was from this particular line, that NBFCs, they are not entitled to accept only those NBFCs that hold a deposit, accepting certificate of registration and have a minimum investment grade credit rating of how much. So basically this question came in the exam. So I've brought some additional information for all of you, but I don't think that you are in the position today to understand this. So this additional information we will discuss in the next session. Just one thing, one last article we have to discuss, that is WMA. Just 2-3 more minutes, then we are done. Okay, so that at least the articles that are in the document that we have completed, the additional information I have brought it separately for all of you, so that you have some articles, some extra information. Chalo bas WMA, let's discuss this. Anyone has any idea what is WMA? Yes, RBI. WMA is the ways and means advances. These are the advances that are given by the Reserve Bank of India to the government of India to meet the imbalances, to meet their imbalances in their expenditure for a short period of time. Okay, so ways and means advances are for the maximum period of 90 days. Within 90 days, it has to be returned. So ways and means advances are basically advances that is given by the RBI to the government of India, that has to be returned by the government of India. These advances have to be returned by the government of India within 90 days. And these advances are basically to meet the short-term imbalances in the government of India's expenditure. They are doing more expenditure than the receipts that they have. So to meet the short-term imbalance, the advances are given, the loan is given by the RBI, and that has to be returned within 90 days. Now, what is the interest? RBI takes some interest from the government of India, or this is free money? RBI takes the interest from the government of India. Yes, the interest is equal to repo rate. Okay, so whatever is the current repo rate, that same interest will be taken for the ways and means advances. That is the idea. So basically, Reserve Bank of India, in consultation with the government of India, has decided that the limit of ways and means advances for the first half of the financial year 2026-27, that is from 1st April 2026 to 30th or 31st, whatever it is, 30th September 2026. So for the first half of the financial year, 2,50,000 crore will be the limit for the ways and means advances. Okay, so this much the RBI can lend to the government of India for the time period of 90 days. That has to be, money has to be returned within 90 days. Government of India has to give interest that is equal to repo rate. Now, if overdraft is happening, that means if for a more money is required by the government of India, or if higher amount is taken by the government of India, or for more time period the amount is taken by the government of India, if the overdraft is happening, so the overdraft will be at repo rate plus 2%. Okay, so overdraft is at repo rate plus 2%. Now, when the government of India has already utilized 75% of the WMA limit, so RBI may trigger fresh flotation of the market loans for the government of India. So basically, if the government of India has already used 75% of the 2,50,000 crore So the RBI recognizes that the government of India might require more money. So the Reserve Bank of India, on behalf of the government of India, can release the market, can release the government securities, new government securities, to get the money. So basically, if 75% of the WMA limit has been met, if 75% of WMA limit has been met, so Reserve Bank of India, on behalf of the government of India, issues the new government securities so that the government of India can raise funds from the investors. Government securities, I hope you know, they are the debt instruments through which the government of India gets the money, collects the debt, or collects the money, gets the money from the investors. Yes. Treasury bills, dated government securities. Okay. So government of India can raise the funds through the government securities that are issued by the RBI on behalf of the government of India. Any confusion, anyone now? So WMA limit for the April to September 2026 is 2,50,000 crore. It is 75% of the WMA limit. As soon as this is met, then the RBI on behalf of the government of India releases the fresh flotation of the market loans, the new government securities, so that more money can be collected for the government of India. And the WMA is given at the repo rate. Overdraft is at 2% higher than the repo rate. Chalo. Now, before ending the session, let me show you the document that everything we have covered so that you do not have any confusion while going through the document. I know this is becoming a little hectic, but I hope that okay. So basically, we have, I'm not able to clean this. Uh, so basically, yes, we have covered the first article, that is the renewal of a bilateral swap arrangement. This has been done. Everything that was given in the document has been discussed. Non-banking financial companies, prudential norms, this also we have discussed. Owned fund, we have discussed for which entities this is applicable. Just remember it, very important. Then we have discussed the quarterly profit have been added, the formula we have discussed. Okay. Next is we have discussed about the right of use assets also. We have discussed about the standalone primary dealers. Same formula will be applied here, but for the tier 1 capital, there is some additional information that I have brought for you, like the additional information I have brought for you that we will discuss in the next session. So this additional information, some limits for the NBFCs, because from the NBFCs, the static question has also come. So some static part I have brought for you that we will discuss in the next session. Okay. Now, prudential norms, declaration of dividend, this we have discussed completely, like applicability and all the important points we have discussed, the 75%. And so the whole table we have discussed, the whole article we have discussed. Okay. You can read it once also. In the next session, see, in the next session, before starting with the new document, first we will revise this older document. I will ask you the rapid fire questions. So in the next session also, do not worry, we will revise it once. So we have also discussed this prudential norms for the RRBs, like for the small finance bank, payment bank, RRBs, local area banks. This also we have discussed. This article is also done. Capital adequacy amendment directions also has been done, where we have discussed about the counterparty credit risk and the add-on factors. So this is discussed. Okay. Next part was foreign exchange management, export and import. This we have discussed. Again, the export and import of currency regulations. Digital Payment Awareness Week, 622nd meeting of Central Board has happened. Not important. See, this was added in the document because the Utkarsh 3.0 was approved by the board. Now, Utkarsh 3.0 is a separate document that we are going to discuss in the session, that is for the Utkarsh 3.0. So that's why here it is not important now. Okay. So Central Board is the top governing body of the Reserve Bank of India. It meets at least 6 times in a year, and at least one meeting is held in each quarter under the chairmanship of the governor. And in this particular meeting, the important thing was that Utkarsh 3.0 has been released, but all about the Utkarsh we are going to discuss in a separate session. So nothing much to discuss here. Unique identifiers has been completed. This we have discussed in detail. NOP INR, net open position INR, we have discussed this. And the last article was WMA. This has also been Done. Chalo. So your document is complete. Any confusion, anyone? Sorry, I was not seeing the. Yes, the facility is available, like the WMA. Sorry, the WMA. This facility is available for the state governments also, but for the state government, separate amounts are released, as well as for the union territories also. But for them, the separate amount is released, separate limit is released. Okay. See, infographics before the examination, if you have to revise in a faster manner, then you can use the infographics. Okay. I will suggest you just read through the document once. Okay. You can use the PPT, the PDF of the PPT or the document, whichever is more comfortable for you. But these infographics, they are very, very important. Okay. These infographics, they will help you to revise in a very limited time because the PPT is lengthy, the document is a little lengthier. But these infographics, they will help you to cover everything in a limited time. Okay. So now let me share the PPT with you. Chalo. Let me share the PDF with you, all of you. In YouTube, I'm closing the session. So thank you everyone for joining. Here, I will share the PDF and then we will close, okay?